Well, good morning, everyone. Welcome. I'm Stephanie Fisher with the Education Department. Thanks for joining us today for key ratio analysis. Wish we were with you in Marquette or Lansing, but this is the next best thing. You've got a great day in store ahead of you. Lots of content in store for you. So excited to always host David Osborne as a speaker. A couple of housekeeping things real quick. David will reiterate this as well. It's a really open format, so please ask your questions. Verbal is preferred, of course. If you didn't receive the PowerPoint I sent out, please let me know. I'll resend that to you as well. We are recording, so I'll send you that link. And then please just provide your feedback if you have any. David will go through your schedule. I know we'll end early, it's Friday, but he likes to make sure that you have a minute to refresh your coffee, use the restroom, and take some breaks. So he'll go over that schedule as well. So all that being said, we've got 3 more trainings with David coming up the 1st of September that I'll email out to you. So keep those in mind. And those are hybrid. So we'd love to have you join us here in Lansing or virtually. And then the end of July, we've got 2 that will be up in Marquette. So those you can join in Marquette or virtually as well. So I'll send all 5 of those out actually. So I wanted to introduce our presenter today. David is the founder and managing member of David L. Osborne and Associates LLC. They are a Las Vegas-based business training and contract CFO firm who provides speeches and training for trade associations, banks, CPAs, and other business partners around the country. He also serves as a contract CFO for several clients, including construction companies, medical practitioners, real estate developers, and co-manages a bank educational program with the University of Nevada there in Las Vegas. He has extensive professional background encompassing, I believe, about 30 years in banking and finance and marketing. He brings a wealth of knowledge to you, and you're going to have a great time with David today. So welcome, David.
Thank you so much, Stephanie, and welcome everyone to today's session. It's great to be with you. Today, we're going to be talking about key ratio analysis. We'll both be calculating and interpreting the numbers. Now, as Stephanie mentioned, if you should have the material, the PowerPoint presentation for today's session. If you haven't done so, I'd recommend that you print that out. Also, if you grab a highlighter, a pen, so you can take notes right on the slides themselves. And we will be going through multiple models today. And so I recommend that you take notes. Also, following today's session, I would also recommend that you keep the material in a binder. In fact, all of the sessions that you, pardon me, would attend through or will attend in the Michigan Bankers Association, whether it's webinar-based such as today or ground-based, as Stephanie mentioned, on the 28th of July. So later this month, I'll actually be physically in Marquette. We're going to be doing credit analysis basics. And on the 29th, so just 2 weeks from today, we'll actually be doing basic tax. It's both basic personal and business tax return analysis. Both of these classes, I would recommend that you take. They would be a good extension, if you will, continuation, extension of today's concepts of good, solid underwriting of the commercial loan. Now, with that, we're going to start off with just a little more housekeeping. As Stephanie mentioned, we're going to take 2 breaks in the morning, 2 5-minute breaks, 2 5-minute breaks in the afternoon. We'll take a half-hour lunch, approximately noon your time, Eastern time. So about noon, we'll take a half-hour lunch break. And then we'll wrap up probably a little early because we've got a smaller class today. But we will cover all the material in today's presentation. Now, with that, let's go ahead and do self-introductions. Now, as Stephanie mentioned, the preferred, or alluded to, the preferred way to interact today is through the audio. If you don't have a speaker on or a mic on your computer, you can always participate via the chat. But let's reserve the chat for just those individuals that actually need the chat. The preferred, once again, is the audio. Okay. And this is going to be live interactive. This is no different than a couple weeks from now in Marquette or in September. I'm going to be physically, as she mentioned, I will be in Lansing and of course, and so forth. So a ground-based session, although we'll be taping those as well. Now, what we need from you is I'm going to shout out your name, but if you'll give us your bank, what do you do in the bank? So your name of your bank, what do you do? What's your, not necessarily your title, but your main function within the bank? And then number 3, where are you located in Michigan? Just so that we can kind of get a feel for your geographical location, because obviously Michigan is a very diverse state geographically and population wise and so forth. We've got lower Michigan, and we got the Detroit market, Lansing, Grand Rapids. We've got Traverse City to the north. We've got, of course, the UP and so forth, Marquette and other parts of the UP, Upper Peninsula. But so we'll start with, let's see, Josh, can you give us your introduction, please?
Hi, yeah. My name is Josh Ball. I'm actually a commercial lender with Nicolet National Bank up here in Marquette,
Okay.
stationed out of Marquette.
Okay, excellent. So you're in Marquette, and I'll be there once again a couple weeks from now. Good. Let's see. Olivia, can you give us your introduction, please? Olivia. Okay, hold on. Let's see. Phone's not working. Give me a minute. No problem. No problem. Okay. Has Jacob joined us? Has Jacob joined us? Jacob Burke, have you joined us? Looks like Jacob hasn't joined us yet. Hopefully he'll join us in a few minutes. Okay. Wait just a moment, see if Olivia can. She's just got a little technical difficulty. And that happens, of course, with webinars and Zoom and even in ground-based sessions. I was in a ground-based session a couple of months ago, and the projector, which was, it was as a training room. It was, attached to the ceiling of the room, and it was kind of all messed up. It was, so, I mean, technical things happen. So wait just a moment, see if Olivia can join us. Okay, well, while we wait for that, if you'll turn with me to page number 2. Page number 2 is my bio, and Stephanie, our administrator with the MBA, she's already given us some on that, but let's see, hold on a second. Has Olivia, have you joined us?
Yes, I have. I'm so sorry.
Oh, no problem. Okay, well, go ahead. We'll have you do your intro, if you would, please.
No, yeah, of course. My name's Olivia Johnson. I currently work in the Escanaba branch of Bay Bank, which is located in both Gladstone, Escanaba, and Rapid River. I currently work with the commercial lending team as their brand new credit analyst, so I'm super excited to sit down and learn today.
Great. Thank you. And you're based in Escanaba. Good. Okay, let me ask, has Jacob, I don't see Jacob hasn't entered the room, but when he does, we'll have him do his introduction. Excellent. Thank you, Olivia, and welcome. Now, as I started to mention that here's my bio, and I'm a business trainer, a contract CFO, and a college professor. I'm also a former commercial lender. I worked at Bank of America for about 9 years, but also worked at 2 community banks. And so now let's see, Josh, yours is a community bank. Is that correct?
Yes.
Okay. Olivia, yours is a community bank?
Yep.
Okay, great. So both of you can relate to that world, and I can relate to your world, having worked at 2 different community banks as a commercial lender. Bottom left-hand side of the page, you'll notice I'm based in Las Vegas. So been in Las Vegas for almost 35 years, believe it or not. But I do want to emphasize, I do travel around the country, such as in a couple of weeks from now, I'll be in Marquette once again. And I've trained in Gladstone, I've trained in Marquette in the UP, trained in Lansing, also trained in, I train not only, for whatever's worth, the bankers in Michigan, but also the CPAs. So I've trained the CPAs in Grand Rapids. I've trained over in the Detroit market, in Troy, Michigan, and so forth, suburb of Detroit, and away we go. So I do go around the country, not as much today as pre-pandemic. And of course, during the pandemic, off the road completely for multiple months and doing the webinar-based training such as today. Okay, so once again, couple of breaks in the morning, couple of breaks in the afternoon, half-hour lunch break, live interactive, and the mics are working. The sound is great, and hopefully Jacob will join us. Now, just you can see at the bottom left-hand side of this page even further, there's my email address, and I've underlined it. DL Osborne at cox.net. And you'll notice it's with the URN instead of the more common ORN. So it's Osborne instead of Osborne. If you would highlight that, if you've got your highlighter or circle that, pardon me, please keep my contact information. So I do emphasize 3 items. If you have a question on, related to today's subject or any subject related to commercial lending. And once again, on the 28th of this month, we'll do the credit analysis basics, and which we will do some of today's session in that session, but we go into other areas of lending, consumer, mortgage, commercial, and it's kind of a wide variety. And I recommend you that if you'd attend the ground-based class on the 28th of this month in Marquette. And then on the 29th, the tax, basic personal and business tax return analysis. So now, and that's mainly from a commercial lending perspective. Now, but if you have questions, even a couple of months from now, or 6 months from now, or a year from now, or 2 years from now even, don't hesitate to send me an email. I received an email just the other day from a person that attended one of my sessions just like 2 years ago or 3 years ago. And they've got a technical question related to cash flow analysis and so forth. So I emphasize, don't hesitate to reach out to me, even, like I said, 6 months, a year from now, what have you. I emphasize 3 items. Pardon me. Number 1, if you send me an email, everything stays confidential. Number 2, I don't charge for this. I don't charge for it. Number 3, I do receive emails regularly. And if it's a pretty basic question or a question I can answer with a pretty, simple response, email response, I'll do so. In fact, I had a couple of them just yesterday. But if it's a little more complicated, the circumstance or the situation, I'll actually get on the phone with you and review the numbers. So later today, I'll actually be doing that with a couple of people that have sent me emails just recently, because their questions are, I could respond to them, but it would take me, a page or even 2-page email. It's like, whoa, multiple paragraphs. In those circumstances, I'll actually call the credit analyst, the loan officer, you name it. Okay. All right. So please keep my contact information. You'll move forward to page number 3. Now, we have 7 distinct areas that we're going to cover in today's presentation. At the top of this page, if you would please put this in your notes, 7 distinct areas. Okay. The first area, then I just write them in your notes at the top of the page, if you would please. And once again, I encourage you to take notes, take your highlighter, grab a highlighter if you haven't done so, and grab your pen and just take a lot of notes as we move forward through the material. But section number 1 is our introduction to key ratio analysis. Section number 2 is called the LALOC model, LALOC. It is a 5-step key ratio analysis model. It is the heart or focus of today's class. It's the heart or focus of today's class, LALOC. Section number 3, accounting. What do you mean by accounting? Well, we're going to step away from the key ratios for a moment in section number 3 and talk about the importance of the underlying financial statements. The underlying financial statements, meaning their accuracy. Well, why? Well, it's because it's from those financial statements that we receive the numbers that we use within the key ratios. If our underlying financial statements are accurate or relatively accurate, obviously there's different levels of accuracy, or levels of reliability, if you will, on the numbers. But even a company prepared financial statement, the lowest level, can still be accurate. People think, well, and I've seen this with a lot of lenders, credit analysts, loan officers, well, that's company prepared. We don't put much, we don't hang our hat much on those numbers. Well, I've worked with a lot of clients as a CFO, as a contract CFO, and previously as a loan officer, worked with multiple clients where the company prepared numbers are clean. They're accurate because the individual controller or CFO of the company is very good at what they do. So in that section, we're going to talk concerning the accounting. In section number 4 of our 6 sections, section number 4 is the LALOC model expanded, LALOC model expanded. Okay, so the LALOC model expanded. Okay, and that's where we're going to actually crunch the numbers. And I recommend that you have your calculator. You could use your phone calculator or a separate calculator, or if you have Excel pulled up, you can use Excel to build the formulas and actually do the key ratios that we're going to be covering, because we're going to be doing hands-on, especially on the front end of today's session, is more calculating with some interpretation. The back end of the session is we're going to look at a spreadsheet and simply the numbers are given to us and we will interpret the numbers. But we're going to emphasize both disciplines today in key ratio analysis, calculating and interpreting. But the first case study, and we have 2 case studies. The first case study, we will actually physically crunch the numbers and interpret the numbers. The second one, the spreadsheet, case study number 2, will be given the numbers, but then interpret the numbers. Okay, so section number 4 is LALOC expanded. Section number 5, industry comparisons and the spreadsheets. Industry comparisons and the spreadsheets. Section number 6 are 2 advanced key ratios for today. 2 advanced key ratios. Number 1, the Z-score, a bankruptcy predictor. Number 1, the Z-score, bankruptcy predictor. And number 2, the sustainable growth model. the sustainable growth model, section number, the second major of the advanced key ratios. So section number 6, the 2 advanced key ratios. I think you'll find those interesting. We'll cover towards the end of the session. Okay, now, before we proceed forward in our introduction, need to just have a polling question. On a scale of 1 to 10, and by the way, we're amongst friends. We're in this class together, so I just want you to feel comfortable, that speak freely and so forth. On a scale of 1 to 10, 10 is the highest, 1 is the lowest. 10 is the highest, 1 is the lowest. How would you rate your skill set with key ratio analysis? And we're amongst friends. Take just a moment, think about it. 10 is the highest, 1's the lowest. You can be anywhere in between. How would you rate your current skill set before we get into the material with key ratio analysis? Josh, what number would you give yourself, please?
Probably a 2 or 3.
2 or 3. Okay. Olivia, how about you?
Oh, you're doing better than me, Josh. I'll give myself a 1, 1.5.
A 1. Okay, a 1. I love it. Okay, good. Just gives me a feel. Good. Excellent. Thank you for those. Okay. Now at the end of the session, of course, those numbers will be expanded. Of course, they'll grow because we will have gone through all this material. And once again, I encourage you to keep the material in a binder, and then each of the sessions that you attend through the MBA, boy, yeah, just keep them, whether they're webinar or ground-based webinar, either way. Okay, now our introduction. This first section. Who uses key ratio analysis? You can see on that first paragraph, the banker, you, bond company, bonding company, underwriters, and so commercial real estate investors, on and on and on. Even the CPAs. I train the CPAs regularly, as I alluded to, and bankers, CPAs, attorneys, those are my 3 largest groups. Now look at the 4 players, so to speak. The creditor, I'd circle or highlight bank loan officer and bond rating analyst. Now you're in that position of the bank loan officer. Whether you're a loan officer, credit analyst, that's your position. You represent the bank, which is a creditor. Okay. Look down below in that second line, company's ability to repay its debt. Boy, that's the biggest, or I should say the most important of the 5-step LAYLOT model. Jumping ahead is the C, the very end, the C, cash flow. We want to make sure, can they repay the debt? But all of these key ratios are important. But number 1 would be cash flow. Well, look at bond rating analyst. Pardon me, a bond rating analyst. Those are individuals that hang out on Wall Street, typically. What do? Well, the bond rating analyst, they will analyze the large publicly traded corporations such as Walmart's ability to issue this bond. Well, what's a bond? A debt instrument. $100 million bond Walmart will issue, so that it's a debt instrument. Now they'll issue $100 million in common stock or equity, but $100 million in debt in the form of a bond. So they issued this bond, this piece of, used to be a piece of paper, now it's all virtual, of course. And the bond holders will, or investors will buy into the bond. Well, from a very similar perspective from you, they want to make sure, can the company, in this case Walmart, repay the bond over a 10, 20, 30-year period? Let's shift to investor. Stock analyst, I'd circle stock analyst. They look at the numbers differently. Efficiency, risk, growth. For example, if you'll put under right in that investor, ROA, ROE, ROA, return on assets, ROE, return on equity. ROA, ROE. Well, from a stock analyst perspective, especially dealing with the large publicly traded corporation, ROA and ROE are huge. These are reported quarterly. But from your perspective, no. Some lenders will try to do those, but I dare say that most of your clients are small to medium-sized businesses. Is that true, Josh, in your world? Small to medium-sized businesses.
Yes.
Is that true in your world, Olivia?
Yeah, that's generally how it goes.
Okay. Well, because of that, we're not going to really emphasize the ROA, ROE, because those are, once again, those are reported quarterly on Wall Street. Pardon me, for the big publicly traded corporation. But for the stock analyst, oh, that's huge. Well, what is ROA? Well, it's the yield or the return on the company's assets, defined as net income divided by total assets. Net income divided by total assets. What about ROE, return on equity? What's the yield or the return or yield on the equity of the company? ROE. So it's net income divided by the equity or net worth of the business. So they look at the numbers differently. Yield, efficiency, so forth. Look at manager, business owner. Okay. Business owner versus the manager. We're going to use an imaginary scenario today. ABC LLC, small manufacturer right outside of Gladstone, small little industrial park right there in the UP. Okay, now, who owns the firm? Who owns the company? And they'll run as high as 50 employees, but their typical is about 30 employees, but they'll go as high as 50 at times. Small manufacturer industrial park right there in Gladstone area. Okay. Who are the owners? Bob and Sue. They're the business owners. Who's their manager? I put in your notes, Jane. She's their CFO / controller. We'll just say, to make it simple, we'll say she's their CFO, chief financial officer, small company, CFO, controller, what have you. They have an independent CPA by the name of George, who's based where? Up in Marquette. He's based in Marquette. Okay. Now, I started with them years ago and they've just stayed with them ever since. So, CPA in Marquette, George. They're based in Gladstone. Okay. Now, Bob and Sue, ABC LLC, Jane's the CFO, George is the independent CPA. Now, I put in your notes next to business owner also, the letter P stands for principal. Bob and Sue are the principals of the business. Jane is the A. I put the letter A next to manager. That stands for agent, principal agent, principal agent relationship. Now, the principal agent relationship is sometimes strained. Bob and Sue may believe in the numbers, the key ratios one hand. Jane, the CFO, may say, oh no, I think the numbers are over here. Now, sometimes they don't agree. Sometimes Bob agrees with Jane, the CFO, versus Sue, or Sue and Jane agree versus Bob. I'm going to say it straight out. One thing that I did not realize was when I was a commercial lender on your side of the table, I never realized how much internally that the business owner and their manager either get along or they don't get along. Now, sometimes I would see it as their lender. You could kind of pick up on it. But the businesses that I banked, that when I was on your side of the table as the commercial lender, that there were the most effective, in my opinion, were those businesses that, wow, the business owner and the manager or principal and agent they would debate the numbers, but in the end, they were in sync. They were in agreement on the numbers. But sometimes they're not. And that's even common within the bank. You may have one opinion of a particular loan relationship versus your team leader and your boss versus credit administration. Now, it's normal and it's good, in my opinion, to have a certain level of friction. You don't want to just be, oh yeah, we agree, and just, you don't really agree. You just say we agree and away we go. You want some conflict to a level, to a certain degree, but not too much to where it goes over the top and it impacts the relationship internally. You as a lender, the same way, in my opinion. And as a contract CFO I work with businesses right now where the businesses will, on a regular basis, they'll work with the CFO, what have you, work with the business owner. I'm a contract CFO, not full-time with any one company. Well, it's good to see that they're in sync generally, but also it's good to see that they don't always agree. There's got to be a certain level of friction, if you will. Otherwise, they may miss the mark, if you would. So once again, when I was on your side of the table, I didn't see as much. Of course, you can't because you're not in-house. But once you're in-house, you see a lot more of the dynamics played out daily, weekly, between business owner and manager, moving right along. And a lot of it internally, believe it or not, is even the key ratios. We're looking at the receivables, looking at the company's financials overall. A lot more than you would imagine, especially if they have a Jane, a good solid CFO controller, versus, not to offend, nothing wrong with this, versus a bookkeeper, a lower level type of employees when it comes to accounting and finance. Let's go down to number 4. If you would circle or highlight business owner, and on the second line down, related ratio analysis. Related ratio analysis. Now, what is that? Well, when we get into these key ratios in just a few minutes, we get into the Laylott model expanded. Not all, but many of the 5-step Laylott model key ratios. We're going to not only do the business side, but we're also going to do the business owner side, the related. And the reason why is that most of your borrowers are small to medium-sized businesses. And so the business and the business owner, to a degree, are one and the same. Okay, now, so we're going to look at not only business key ratios, but not all, but some of these of the 5-step model for the business. We'll do the equivalent or the extension into the individual business owner, his or her personal key ratios or personal financial analysis tied into that section of the business. I think you'll find that interesting. Now, at the very bottom of this page, right below guarantor, right below related ratio analysis, if you would please put in your notes, alter ego theory. Now, what's alter ego theory? Alter ego theory is where the business and the business owner, it's understood, it's recognized, the business and the business owner are the alter ego of each other. That means they're kind of the mirror image of each other. And this goes back to this whole concept with small to medium-sized business borrowers, commercial borrowers. We've got to look at at least some of the related ratio analysis. Look at Bob and Sue's personal financial position, because otherwise we miss essentially half the story. Once again, with small to medium-sized privately held businesses, unlike the Walmart or the Microsoft or the General Motors or whoever, they're the alter ego of each other. Legal phrase. They're the mirror image of each other. Let's move forward. Now, section number 2. This is the Laylock model. These are the 5 areas we're going to work on today extensively. And we will use these in both of our case studies. Case study number 1, case study number 2. Now, let me give you a brief definition on each of these. If you just put them off to the right there, please. Pardon me. Liquidity. The company's ability, defined as follows: the company's ability to service its short-term obligations. The company's ability to service its short-term, less than 12 months, less than 12 months. Here's another way to define liquidity. The second definition is the nearest to cash, the nearest to cash. How about activity? Model number 2, activity. The swing factors or turn factors. The swing factors or turn factors. They swing up, they swing down, swing up, swing down, turn up, turn down, turn up, turn down. Specifically, we're going to be looking at AR, AP, and inventory turnover. Accounts receivable, accounts payable, and inventory turnover under activity. Leverage. Leverage is defined as the company's ability to service its long-term obligations. Company's ability to service its long-term obligations, more than 12 months. Even think in terms of, 3, 4, 5 years out. 3, 4, 5 years out. Okay. Number 4, operating performance, defined as the profitability of the business. The profitability of the business, or lack thereof. If it's a loss, if they're in a loss, the profitability of the business. And then lastly, as I mentioned before, the number 1, cash flow. Cash defined as follows. Pardon me. Cash in versus cash out. Cash into the business versus cash out of the business. Another way to describe or define cash flow, 2 words: lifeblood. Lifeblood. The lifeblood of the business is the company's ability to really live, to survive, and to grow. The same way with the household. From a financial perspective, what's the lifeblood of a household? From a financial perspective, it's its cash flow. That's the blood, if you will, of the main workings of the household, financially speaking. Same with the business. Now you'll notice, of course, and please, if you'll circle the first letter of each one of these: L for liquidity, A for activity, L for leverage, O for operating performance, and C, of course, for cash flow. LALOC, or Laylock for short, the acronym. Now, what we're going to do is we're going to do 2 quick activities related to the overall Laylock model. Overall Laylock model. To the left of liquidity, you should have a little little border there, a little section, a little space there. To the left of liquidity and 1 line up, if you will please put short term. So to the left of liquidity and 1 line up, just put in your notes real small, short term, meaning less than 12 months. Less than 12 months. Now, what I'd like to have you do is prioritize the Laylock model. What would be number 1, 2, 3, 4, and 5? And give you the hint: to the left of cash flow, the left of that bullet point, if you put a number 1, put a number 1. As I mentioned before, cash flow is the number 1. So from a short-term perspective, less than 12 months, we're talking short-term, borrowing that concept from accounting. Short-term is typically less than 12 months, long-term more than 12 months. Number one is cash flow. In your opinion, in your thought, from your perspective, what would be number two? What would be number three? What would be number four? And what would be number five? I've given you the definition of each one of these. We haven't seen the numbers. We won't see that until section 4, where we actually crunch the numbers in depth, in detail as well. But big picture, the Laylock model, short term, less than 12 months. What would be number 2, 3, 4, and 5? Number 1 is cash flow. Take just a moment on this. And then I'm going to ask you your thoughts. What would your thoughts be? From a priority standpoint, from a short term, where the hint is less than 12 months, less than 12 months, less than 12 months. What is number 1? Cash flow. What's number 2, 3, 4, and 5? Take just another moment on this, if you would, please. Pardon me. What's number 2, 3, 4, and 5? Okay, here we go. Josh, can you give us what would be number 2 in your opinion? What is your number 2?
Sorry.
No
Liquidity.
problem. Liquidity. Good. Olivia, what did you get for number 2?
I had liquidity as well.
Excellent. Olivia, what did you put for number 3?
3 in that aspect, I was fighting between activity and operating performance, but I put operating performance as 3.
Okay. Number 3 should be activity. Okay. All right. Josh, what'd you get for number 3?
Activity.
Josh, thank you. What'd you get for number 4, Josh?
Leverage.
Olivia, what'd you get for number 4?
Number 4 was, well, it was activity, and then so now the rest are screwed up.
Okay. So what would you say is number 4 though? If you redid it. So number 1, cash flow. Number 2, liquidity. Number 3, activity. What would you say? You're right on. You are right on, Olivia. Operating performance. And number 5 is leverage. So number 1, cash flow. This is short term. That's the whole key to this first one. Number 1, cash flow. Number 2, liquidity. Number 3, activity. Number 4, operating performance. And number 5, leverage. Okay, that's the order. Now, let's do our second quick model or activity on this. If you'll go to the right, past the definitions over to the right there. Now, if you'll put, in fact, to the right of liquidity, way over to the right and one line up, if you will please put long-term. Now, this long-term, remember, think in terms of 3, 4, 5 years out. 3, 4, 5 years out. Way out. I mean, not a year, not 2 years even though technically per in the accounting lingo, it's long-term is anything over 12 months. Well, think in terms of even 3, 4, 5 years out, way out. What's number 1, 2, 3, 4, and 5? Give you the hint. Number 1 is still cash flow. So to the right of cash flow, over to the right, underneath that column of long-term, you'd want to put a number 1. Put a number 1. Now, what is number 2, 3, 4, and 5? And the hint is, pardon me, think of big picture. Think of the big picture. Think of the big picture, meaning of the business. and its finances and its financial condition. Big picture, long term, 3, 4, 5 years out. The hint is for the second one is if they don't have a positive number in this figure, woo, they're not going to survive. Long term, that's number 2, then 3, 4, and 5. Take just a moment. We'll come back together. Number 1 is still cash flow. Pardon me, even in the long term. But what's number 2, 3, 4, and 5? Priority. Okay, Josh, what's your number 2, please?
Operating performance.
Operating performance. Olivia, what's your number 2?
Operating performance.
You are both correct. Excellent. So it's cash flow number 1, operating performance number 2. If they don't reach positive operating performance in the long term, traditionally they will die. Wow. Josh, what'd you get for number 3?
Leverage.
Correct. Excellent. Olivia, what about number 4?
For number 4, I had activity.
You are correct. And lastly is liquidity. Lastly, liquidity. Good. Excellent. Okay, now we've got the rearrangement. We've got short term, we've got long term. Now you're looking at the order that we've got, the printed order here on page number 4, liquidity, activity, leverage, operating performance, and then cash flow. And you're going like, well, wait a minute, that's neither short term or long term. Well, and that's true. For whatever's worth, this is the traditional order that most banks will use. Now, they may switch some of these. I've seen one where activity and leverage were switched the order within a particular bank, but generally speaking, this is the traditional order that we would use within our loan write-up or credit memorandum. Within the loan write-up or credit memorandum. Josh, do you work on the credit memos, within the bank, the loan write-up? Or do you input into that in your bank in Marquette?
I input just comments. My analysts do, the large credit request, the analysts do
Gotcha.
that. The majority
Got
of it,
it.
I just put
Got
minimal
it.
comments.
Okay, good. Olivia, how about you? Do you actually do the write-ups or part of the write-up or input into it?
I'm still baby stepping my way through my credit analyst
Gotcha.
position.
No problem.
So
No problem. So not yet. Okay.
not yet.
Not yet. But for whatever it's worth, this is a very common, what's actually printed, not the short term or the long term. And you think it'd be one of the, short term or long term. Well, it's this for whatever it's worth. You'll notice cash flow is the very end. Well, it's kind of the crescendo, if you will, of the analysis. Now, what about the compass on the bottom right-hand side of this page? Why did I put a compass here? Well, it's to remind us that this discipline of the key ratios, well, whether we're talking short-term, long-term, or the traditional order, if you will, that's printed, no matter how you look at it, the goal with the key ratio analysis is to give us the direction of the business. What direction is the business going financially speaking? Now, are these the various key ratios, the models we're going to actually talk about in a few minutes in section number 4, where we crunch the numbers, we actually mathematically use the financial statements, balance sheet, income statement to calculate the key ratios. Are these key ratios perfect? No way. They're not. None of them are perfect individually or even collectively. But the key ratios do give us, as you can see, the compass, the direction that the business is going financially. That's really the overarching viewpoint of key ratio analysis, especially the entire Laidlaw model as a body or as a group, the direction of the business financially. Let's move forward. Now, section number 3. The accounting section, section number 3, the accounting section, we have the 4 basic financial statements: the income statement, statement of retained earnings, balance sheet, statement of cash flows. Okay, now you can see under the income statement, the basic component part, revenue or sales, minus expense gives us net income or net loss. Statement of retained earnings, retain earnings, beginning retained earnings, plus net income minus loss, minus dividend, or right below dividend, I'd put distribution, same thing. So if we're dealing with an LLC partnership or an S corporation, we call it a distribution. But if it's a C corporation, old-fashioned business, C corporation, it's a dividend. Distribution, dividend, really the same thing. In fact, if it is a sole proprietor, it's called a draw or withdrawal. It's the same thing. It's taking money out of the equity of the business. Gives us then ending owner's equity or retained earnings. Third financial statement, balance sheet. Assets equal liabilities plus owner's equity must balance. And then lastly, statement of cash flows. Pardon me, operating, investing, financing, operating the normal operations of the business. Like if we're talking Walmart, operating would be where they buy the billions of dollars of inventory and they take it into their distribution center, and then eventually from there to from the distribution center into the business or into the regular box stores, if you will. And then of course they mark it up and they sell it to the consumer. This is statement of cash flows, sources and uses of cash. What on the operating, what's the use of cash? When they buy that inventory. What's the source of cash? When they sell it to the consumer with the markup included. What about investing? Buying and or selling fixed assets. Buying and or selling fixed assets. For example, Walmart does not own most of their box stores. They're big box stores. You know, Walmart, Sam's Club, no, they don't. Those are long-term leases, 20, 30-year leases with various investor groups. They do own their distribution centers. Josh, have you ever seen a Walmart distribution center?
No, I have not.
Okay, thank you. Olivia, have you ever seen a Walmart distribution center?
No, I have not either.
They're mega, they're huge. Believe it or not, we have one about an hour and a half drive from Las Vegas in southern Utah, just right off the freeway. You're driving and you're out in the middle of the desert, and you're high desert and the mountains above you, and you're driving along, and all of a sudden out of nowhere, this huge Walmart distribution center. Well, let's say the Walmart distribution center cost $50 million to build, which it may have. Or 20 million or whatever, and we'll just say 50 million. That's a use of cash. Well, then they look at it because it's a fixed asset. They took cash to build and buy that, to develop that distribution center. And by the way, this one that's right off the freeway, the trailers, you know, the semi trailers, there's got to be 100 of them in the parking lot area, the distribution. Pardon me, that's not the building. That's just the trailers out in front. 50 to 100, at least 75 or more, maybe even more. What happens if they decide, Walmart says, you know, we don't need all this land. We've got extra land. Why don't we sell up that 5 acres to the side of us to a non-competitor? And they do. Well, when they sell it, they get, let's say the 5 million or the 5 acres is $1 million an acre, 5 million. That's a source of cash to Walmart in the investing. How about financing? Debt and equity. I put in your notes, debt and equity. The debt, bonds mainly. We talked about $100 million bond, debt instrument. But Walmart, well, they do have 2 or 3 or 4 billion dollar lines of credit with not just one bank, but what's called a consortium of banks, or a syndication of banks, a group of banks, 10 or 15 or 20 banks even. $4 billion, $3 billion, $4, $5 billion line of credit, whatever. What about equity, debt and equity? Equity, $100 million in new common stock. So we mentioned earlier, $100 million in new common stock. Well, what about your small borrower? ABC LLC in Gladstone, Bob and Sue's company, little manufacturer, 30 to 50 employees. Jane is the CFO. George up in Marquette is the CPA. Well, they're operating normal operations of the business, sources and uses. Source of cash when their customers pay. Use of cash when they pay their rent on the building or, pay their employees and so forth. How about investing, buying and or selling fixed assets? They buy a new piece of equipment for the manufacturing firm. Well, what happens? That's a use of cash. They dish out the cash to buy the equipment. Use of cash. Well, but they have some older equipment. Oh, we can sell this kind of used equipment manufacturing to other manufacturers. They sell it, get cash. That's a source of cash in the investing. What about financing? Debt and equity. Debt, your bank loan. You give them a new $750,000 equipment loan or $500,000 equipment loan or $250,000 or whatever. That's on the debt side. What about the equity? Bob and Sue Infuse periodically will infuse cash into the business or equity into the business. Moving right along. Now, of these 4 financial statements, the 2 that we use most readily for key ratio analysis, if you will circle or highlight, income statement and balance sheet. Income statement and balance sheet. These are the 2 that we will use most readily. Okay, now before we move forward, the bottom, we've got 2 more kind of mini models related to this concept of accounting basics or review. And remember, we're doing this because the underlying financial statements, it's important that they're accurate, their accuracy, because otherwise our key ratios, they're based on the numbers drawn from the income statement and the balance sheet specifically. Although we're going to see a statement of cash flows on the spreadsheet later that does tie into statement number 4, statement of cash flows. But boy, the underline's got to be there. So our 2 last items on this, bottom left-hand side of this page, at the very, very bottom, let's start with the lowest level of reporting. Mentioned this a moment ago. Company prepared financial statements. Company prepared financial statements. More often than not, what software does Bob and Sue use? ABC LLC at their company? QuickBooks. Now, some commercial lenders think that, QuickBooks as a software program is not that great. It's not that good. It's kind of lower level because they get the result of the QuickBooks. And for example, the balance sheet doesn't balance. Assets have got to equal liabilities or debt plus owner's equity. And so some commercial lenders I find around the country as I train, they have a misconception, if you will. They have a misconception that if you see QuickBooks software, a financial statement, that it's not accurate. But that's not true necessarily. For whatever it's worth, the software, QuickBooks, is actually state of the art. Most CPAs nationwide, including George up in Marquette, they use QuickBooks. They use it daily with their clients. Their clients use it. It's not the software that's the culprit. It's who's using the software. Does Jane understand it? How good is Jane? Well, she's excellent. Both internally in the company, ABC LLC in Gladstone, and in interacting with you, the lender. All the numbers are timely. Oh, everything you need. She is great to work with. You love working with Jane. Now, moving right along. So company prepared's the lowest, but they can be accurate. We'll step up, if you would, on your notes. The next one up, level, CPA compiled financial statement. Now, what do you mean by CPA compiled? Well, or compilation. It's where Jane has prepared the financial statements using QuickBooks, primarily income statement and balance sheet. And she emails the file to George from her office in Gladstone to Marquette. George takes those numbers, puts them into his format at the CPA firm, puts a big disclaimer on the front, says, well, this is management. These numbers are management. But generally speaking, the CPA compiled or compilation is a higher level reporting, meaning more accurate. Because if George, the CPA, sees a few little mistakes or little things, he'll adjust them. Let's go to the next one up, even higher level. CPA reviewed financial statement. Pardon me, CPA reviewed financial statement. This is way different. This is where George goes down to Gladstone, camps out for an entire week, slang term, camps out in ABC LLC's conference room at their office in the industrial park right outside of town. Now, George will review, this is where the title comes from. He'll review the books per GAAP, GAAP, generally accepted accounting principles, generally accepted accounting principles, or GAAP for short. Okay, now George will review the books. Still not an audit, still no, ooh, that's the top one. In fact, let's put an audit right above that. The audit is the top, if you will. But in a review, he reviews the books per GAAP, and it's definitely a higher level than CPA compiled, compilation, or company prepared. But it's not an audit. Now let's go to the top tier, audited financial statement. In the audited financial statement, George will look at the books. He'll review the books of the company per GAAP, generally accepted accounting principles. And he'll look at the methods. He'll look at all the internal, called quote unquote slang term, the working papers of the company, or Jane, the CFO. He'll do certain checks on that per generally accepted accounting principles. Now, in this case, generally accepted audit principles. But I put in your notes, not only will he review the financial statements per GAAP, but he'll send out confirmation letters to confirm the numbers. So here's one confirmation letter. He'll send them to your bank. Oftentimes the branch manager gets them. In my opinion, it's the branch manager, and nothing wrong with the branch manager, not to point the finger at him or her, but the branch manager should, in my opinion, only in the confirmation letter confirm the deposit balances as of the year end for the audit, 12/31 of 21, for example. But oftentimes, branch managers within the various banks, this is nationwide, not just in the UP, but nationwide, they will take and do the loan side as well. My personal opinion, they should give the form to your lending department and have the lenders confirm the outstanding balance as of 12/31 of 21 of the line of credit, for example, the equipment loan, if it's a commercial real estate loan, and so forth. My opinion only. So that's number one. That's one of the confirmation letters. Here's another one. George, the CPA, will send out confirmation letters to ABC LLC's receivables and payables. Let's say they have, 15 receivables, 15 different companies. They'll send out 15 letters to those companies and say, would you please confirm the amount of money that you owed ABC LLC as of the audit period 12/31 of 21, confirming the balances. Now, George already has the financial statement in the internal receivable report and so forth, the aging and so forth, but he's confirming the balance. That's why the audit is usually way more expensive than a reviewed compilation company prepared as internal. It's because there's a lot more work to it. He'll do the same on the payable side. Let's say they've got 10 payables or 5 payables, accounts payable at the end of the year, 12/31 of 21. If the receivable and payable aging reports are way, meaning, or lists, not reports, but lists of those are just too many, then George, the CPA, will do a sampling. He'll sample, if you will, so many receivables, so many payables, random sample to confirm. Here's the last confirmation letter. George, the CPA, will send out a confirmation letter to ABC LLC's attorney, legal counsel, because he wants to confirm, George does, is there any legal matters or issues impacting the company? And in the letter he sends to the attorney, it's a little different than to the bank, to the receivables, payables. It's, can you please confirm any litigation, any legal matters? If the answer is no, fine. Attorney, sign the bottom, date it, and send it back. But if the answer is yes, they've got to clarify. And then what the CPA wants the attorney to confirm. Attorney, in your personal opinion, could this legal matter in a material way negatively impact the business, ABC LLC, financially, in a material way? Yes or no? Wow. Now, moving right along, our second and last little activity on this, top right-hand side of this page, if you'd put in your notes the acronym GIGO. GIGO stands for GIGO, or it's just pronounced GIGO, G-I-G-I, GIGO. Now, what does it stand for? It's an acronym. Garbage in, garbage out. It's an old saying from decades ago in America. You used to hear it all the time in American business. Garbage in, garbage out, which means if the underlying financial statements are garbage, and we're using the income statement and the balance sheet to calculate the Laylock model, there is an impossibility that your key ratio analysis can be accurate. There's no way. Now, your calculations could be perfect, but they're based off of erroneous or inaccurate underlying information. Garbage in, garbage out. So once again, going back to the bottom left-hand side of the page, you can have a company prepared financial statement, but oh man, does the balance sheet balance? Is it accurate? What about Jane? What about her team? She's got 3 employees, small manufacturer, 30 to 50 runs, 30 minimum, but sometimes depending on their work, they'll add more employees, go up to 50, as much as many 50 people. Jane has a small team, 3 people reporting to her, so there's 4 of them in the accounting finance department. How accurate, how accurate. GIGO, garbage in, garbage out. Now turn forward if you would. Now we're in section number 4 of our 6 sections for today's presentation. Now this is expanded Laylock. This is where we're going to crunch the numbers, analyze, we're going to crunch, we're going to calculate, and then we're also going to interpret extensively. We're going to use our first case study in just a moment. You'll see this in just a moment. Pardon me. Now, Definition. Here we go. Definition. Let's restate it so you have it again. We did it earlier in the laylaw, but let's do it again. Definition. Liquidity. The company's ability, to service its short-term obligations. Company's ability to service its short-term obligations less than 12 months. Another way to define it, the nearest to cash, the nearest to cash. Okay, before we do this, before we get into this model, before we forget, the top left-hand side of this page, I'm going to ask a question. We're going to go back to, in fact, let's turn back one page before we do this. Just a thought. The top left-hand side of this page on the accounting. Overall, this is a general assessment on a scale of 1 to 10. 10's the highest, 1's the lowest. How would you rate your average customer with the accuracy of their financial statements, whether it's company prepared or what have you? What would you say? Take just a moment, think about it. Just a ballpark. It's just your typical borrower. How accurate are the underlying financial statements? Before we get back into the laylaw model, Josh, what number would you give your typical borrower reporting overall? If you say, oh, real accurate, 8, 9, or 10, you say, no, we struggle with this. Maybe a 3 even. What would you say, Josh, overall?
Say probably a 5 or a 6.
Okay, kind of in the middle, 5, 6, maybe a little higher than middle. Thank you. Olivia, how about you? What would you say your typical?
Yeah, I would say we're in that like 5, 5.5, 4.5 ballpark.
Okay.
Just like that kind of middle of the road.
Okay, good, excellent, good. And is this a true statement, Olivia? Some of your borrowers are better than others when it comes to the accuracy of their reporting?
Oh yeah, I would definitely see some are super detailed in that aspect, and then there's others where it's like you're trying just to get 2019 tax statements.
Oh, 3 years ago. Hey, we need that tax. Oh, that's good, Olivia.
Exactly.
Oh, that is good. But it's true. And well, and I described Jane, she's on the top end, right? She's on the high end of accuracy versus some of these others. Whoa, right? So good. Excellent. All right. Just thought we'd do that quick activity. Now let's go back. Page number 6. Here we go. The laylaw model. Good. I just thought that before we get into the calculations, just ask you two, like, wow, how accurate are the numbers, if you will. Okay, here we go. 3 calculations within the liquidity area. Now this is for the business. Working capital, current ratio, quicker asset test. You can see the working capital is technically it's not a ratio. As you can see, it's a raw number, meaning current assets from the balance sheet minus current liabilities. In fact, if you put 500,000 off to the right, 500,000 off to the right there as an example. And of course, but even though working capital is not technically a key ratio, we more often than not will include it in liquidity in these calculations. Now let's go to current ratio. Technically our first current ratio, current assets divided by current liabilities, current assets divided by current liabilities. So if you put off to the right of that, just as an example, 2.0. How do you interpret that? For every $2 of current assets, $1 current liability. $2 of current asset, $1 current liability. What about the third one? Asset test or pardon me, quick ratio or asset test? Current assets minus inventory divided by current liabilities. No, wait. Why do we chop out inventory in the numerator up above versus the denominator down below? Well, it's because inventory is typically considered the least liquid of the current assets. It's the least liquid of the current assets. So the quicker asset test ratio is a more refined version for whatever's worth as of the current ratio. Off to the right of quicker asset test, if you'd please put in your notes 1.0, 1.0. Okay, now for whatever's worth, a current ratio of 2.0 or higher is an indication of strong liquidity. 2.0 or higher current ratio, strong liquidity. A 1.0 or higher quicker asset test ratio is considered an indication of strong liquidity as well. So in this case, we've got a 2.0 current ratio, quick ratio asset test, pardon me, of 1.0. Boy, they've got strong liquidity. And then $500,000 working capital raw number, well, most people would say for this small to medium sized business, wow, that's strong. That's strong. Okay. Now you're saying like, okay, this is ABC LLC. This is, wow, those are strong numbers because of the old fashioned rule of thumb. But if you'll put in your notes, what at the top right hand side of this page, what is more important than the general rules of thumb, or pardon me, than the old fashioned rule of thumb? It's the two general rules of thumb. Those are the 2.0 down below, the 1.0 down. Those are old fashioned rules of thumb. What about two general rules of thumb? Number one at the top right, self to self. Whoa, what do you mean by that? The company relative to itself. Year end 19, year end 20, year end 21, 6/30 of 22. Year end 19, 20, 21, 6/30 of 22 interim period. The trend, the company, self to self. What about general rule number 2 at the top right hand side of the page? The first one is the trend of the company relative to itself. General rule number 2, self to industry. Self to industry. Okay, now, self to industry. Oh, absolutely, it's self to industry. Well, we're going to look at in section 5 various, and we're going to talk about various industry comparisons. One of the very common ones, which we'll talk about later in section 5, is called RMA, Risk Management Association. RMA, Risk Management Association. A lot of banks use it, a lot of banks don't, but it's a very, very common industry comparison, if you will. Very common industry comparison used by commercial lenders nationwide. Okay, we'll come back to that. So self to self, self to industry. Okay. Now let's illustrate this further. Let's say as of 6/30 of 22, the 6-month period, you have a current ratio of 2.0. And you're thinking, oh, they've got strong liquidity because the old fashioned rule of thumb says 2.0 or higher. But look at the top two, look at the top right-hand side of the page, the two general rules of thumb. Let's start with self to self. What if you go back to year end 19 and the current ratio was 3-to-1, even higher? Year end 20 drops down to 2.5. Year end 21 drops down to 2.25. 6/30 of 22 drops down to 2.0. Whoa, self to self, they're slipping. They're taking it on the chin. They're dropping the trend of the company relative to itself. What about general rule number 2? Self to industry. Self to industry. What if the industry comparison is a 2.6? Whoa, wait a minute. They started at 3.0. They dropped to 2.5, just below the industry, but then they kept dropping. Year end 21, 2.25, 6/30/22, 2.0. Self to self, they've deteriorated. Self to industry, they've deteriorated. Now, I had a boss when I was on your side of the table, no names mentioned. He was a creative key ratio underwriter. He was a creative commercial lending underwriter using the key ratios. Well, literally on the liquidity ratios, if you saw the current ratio, if he had the trend that I just described, where the numbers are dropping, self to self and self to industry, you know, he'd do in his loan write-up is he would say, well, as of 6/30/22, the current ratio is a 2.0, so it's moderate, you know, but you know, and he would emphasize the 2.0 as of 6/30/22, but he would just forget the reality of the trends of the company relative to itself and the trend of the company relative to the industry, conveniently. By the way, how did I know this? Because he was doing his own loan write-up, his own analysis, and I was doing mine. And everybody on our team, we had 4 or 5 lenders, and he was an active lender as well. He had a smaller portfolio because he also managed the team. Well, once a week, on average, he'd walk in my office unannounced. He'd have his legal pad. He'd have either the financial statement as the source document or the tax return. And he'd say, David, can you double check my numbers? And I would look at the numbers, and then he would say, and you know, he would show the current ratio, and then we'd sit there and then I'd go, you know, a few minutes later, I'd go back in his office. Hey, I noticed, boy, the trend of the current ratio, liquidity relative to itself, relative to the industry. Oh, no. And then he would tell me, oh, no, it's 6/30/22 is what I'm emphasizing. And I had a discussion. With Bob and Sue and Jane, the CFO, and he'd literally say this. Oh, and they said, oh, their liquidity is turning around. And I'm thinking, based off of what? He says, oh, they promised me this next quarter, meaning September 30th, 9/30/22. Oh, it's going to be back up. And he'd tell me, he'd go, I'm emphasizing the 2.0 as of 6/30/22. I'm not going to say anything about the trend. Whoa. And numerous others. When we get to step number 5, the cash flow, the C of cash flow of the Laylock model. Oh, you talk about creative. He was a creative underwriter, and he would joke about it in our staff meetings. He'd say, oh, you probably all notice I'm kind of a creative underwriter. Well, he was. Sometimes it would get so extreme that the numbers would just be plucked out of thin air. Usually they would be based on historical fact, meaning the financials, our previous section, the accounting. But the way he would twist the truth was amazing. He would not clearly say self to self deterioration, self to industry deterioration. This is why, and this is what's happening. Oh no, he'd kind of gloss over it. And he knew that credit administrator that's going to read his loan write-up is going to just glance at the 2.0. Oh, that's standard, that and above. Oh, they made it, and move on. And the way he would word the write-up as well was deceptive. Now let's go to adjustment. Then we'll take our first break in just a moment. Now we've done the basic key ratios. Prepaid expenses. Now this could be prepaid rent, prepaid insurance. The company prepays it. It's a current asset per GAAP, generally accepted accounting principle. I put right below prepaid expense, prepaid rent, prepaid insurance. Now it's a current asset, but will it ever really convert to cash? The answer is no. So GAAP, generally accepted accounting principle, says it's a current asset, but for our purpose, key ratio analysis as commercial in the commercial lending arena, if you're spreading the numbers, you would take the prepaid rent, prepaid insurance, and drop it down below as an other asset. Get it out of the current assets. What will it do? Look in the numbers up above. All three of these calculations will drop. They will be more conservative, more real. What about due from officers, shareholders, and employees? If you see a current asset due from officers, that means Bob and Sue have borrowed. They have borrowed from their company. Wow. They borrowed from their company. Well, it's a current asset. But do the owners do they quickly repay? No, they own the business. They're in no hurry to repay that debt. It's a current asset on ABC LLC's books, but from their perspective, well, I own the company. We own the company. Bob and Sue do. Wow. Now, what? So if we see that, take it. And if we're spreading the numbers, we drop it down below the line, meaning out of current asset into other long-term. What are other? What will it do? Make these numbers, these calculations, these key ratios more conservative. What about due from employees? Employees will borrow from their employer. Employee goes to payroll, the manager, and says, hey, can I get a payroll advance? Payday's not for a week and a half, but I need the cash. Week and a half goes, they get it. Week and a half goes by. Oh, I don't have the cash to repay. Hey, can you just put that on my tab? Well, some companies, some of your borrowers will do this to a level. Some say none. But let's say you see $30,000 in due from employees as a current asset. Oh, employees move on, employees are terminated, employees notoriously will default on those loans. So what do you do in your analysis? Drop it down below. Get it out of the current asset category. Josh, does that make sense? Those adjustments down below we talked about here on page 6. Did this make sense to you?
Yes.
You bet. Olivia, makes sense on the adjustments.
Yeah, it makes sense. So you would just subtract it from your current assets before
Exactly.
you continue
Now,
on with your
if you're manually calculating, you would just subtract it. If you're spreading the numbers, and by the way, Olivia, do you spread the numbers like using Excel or Moody's or something?
We do have a program called SageWorks that
SageWorks. We're gonna talk about SageWorks later on. Josh, do you spread the numbers? Do you spread or have them spread for you?
They're spread for me. I do not do the spreading.
And what software do you use? Do you know?
Can't remember off the top of my head.
No problem.
They told me at one point, but I have no idea.
No problem. So, but if you're spreading the numbers or having them spread, the adjustments, you simply just take them out of the current asset. You don't throw them out. But you put them down because you want the balance sheet still to balance to the same numbers. But you recategorize them or reclassify them as other assets. And what happens? It will make your analysis more accurate, more conservative, but also more accurate, as we talked about. Good. Now let's move forward. Let's move to page number 7. Now, this is our first of our 2 case studies. Now we're going to shift this company. We're going to say this is a small manufacturer in Houghton. This is in Houghton, Michigan, in the UP. Okay, so this is not ABC LLC in Gladstone. Okay, they're up in Houghton. This business is owned by one individual by the name of Sawtooth. Whoa, it's a weird name. It's like, what? We'll come back to Sawtooth right after our break. We're gonna use this as our case study. Now, before we get into Snyder Corporation, let's go ahead, take our first 5-minute break, and we'll come on back. I recommend you keep everything up, meaning the Zoom, because I found if you go out of the system, come back, sometimes it gets messed up. I would just mute yourself and so forth. But let's go ahead, take our 5-minute break, and we'll come on back. Thank you. Excellent participation, by the way. Excellent. Talk to you in 5. Thank you. Welcome back, everyone. We'll go ahead and get started in just a minute. Take just another moment or so, and we'll get started. Okay, Josh, are you back with us? Can you do our sound check, please?
Yep, I'm just finishing up something real quick.
Oh, no problem. No problem. Take just another moment or so. You bet. Pardon me. Okay, let's go ahead and get started. Olivia, are you back with us as well?
Yeah. I'm
Great,
here.
thank you. Excellent. Let's see, has Jacob joined us? Just wanted to see if Jacob was able to join us. Okay. Okay, let's go ahead. Snyder Corporation, another small manufacturer, is located in the Houghton Market. It's owned by Sawtooth Snyder, Snyder Corporation. Their CFO is by the name of Beth. Their CPA is George, the same CPA in Marquette, just the same CPA that ABC LLC uses. So George is the independent CPA in Marquette. Beth is the CFO. Sawtooth is the owner, just one owner. Now, take a moment and look at the balance sheets on page number 7 and page number 8, the income statements. Take just a moment and kind of review the numbers. These are in actual numbers. These are not in thousands, of course. Pardon me. These are in actual numbers. Okay. Small manufacturing firm in the Houghton area. Also, at the bottom of page number 8, you'll notice the industry comparisons as well. We'll come back to that in just a moment. So take a moment and review just a general review of the numbers for 19, 20, 21, the balance sheets, and on the next page, page number 8, the income statements as well. So go ahead, take just a moment and review the numbers. We're going to use these numbers extensively to calculate all 5 steps of the Laylock model using Snyder Corporation numbers, if you will. Pardon me. Take just a moment more. Page number 7 and page number 8. Page number 7 and page number 8. Just kind of review the numbers, just a general review. Kind of get familiar with these numbers in this case study, if you will. Okay, now let's look at the industry comparisons. If you'd be so kind as to highlight current and the 2.7 to the right, current ratio. Quick, if you'll highlight quick, and the 1.0 to the right. Inventory turnover 6.1 times to the right. If you'll just highlight these if you would, please. Days sales outstanding, if you'd please put, is the same as AR turnover. AR turnover, accounts receivable turnover, 32 days to the right, if you would highlight, please. Then if you'll drop down about 3 lines down, debt ratio 2.0, debt ratio 2.0, EBITDA coverage 2.0, and lastly, profit margin 3.6. Profit margin 3.6. Now, usually when you see industry comparisons where it says profit margin, they mean net profit margin versus gross profit margin. So if you put the word net right there in front of, right to the left of profit margin, net profit margin, 3.6 times. Okay, so now we've reviewed just generally balance sheets, income statements, and the industry comparisons. Okay, for Snyder Corporation. If you'll move forward to page number 9, what I'd like you to do is to build a table under number 1. Underneath the word corporation, if you would please put 19, 20, 21, and IND for industry. 19, 20, 21, and IND for industry. That's on the horizontal, below corporation, stretching to the right. Then underneath Snyder, on the vertical, if you would please put W/C, C/R, and Q/R. So we're just building the table in order to, we're going to do the numbers. We're going to calculate and plug the numbers in to the table. So underneath corporation, 19, 20, 21 IND for industry. And then below Snyder, just on the vertical, W/C for working capital, C/R for current ratio, Q/R for quick ratio. Okay, now we know the industry is, well, first off, over on the industry, the IND, working capital is NA. It's not available because it's a raw number, but we're going to calculate it. As far as industry comparison, we know back on the previous page, page number 8 at the bottom, we know that the current ratio is 2.7 industry. So under IND, you can put 2.7 for current ratio. The quick we know is 1.0, 1.0. Okay, so now what I do, and what I ask you to do is go back to page number 7 and 8, and
David,
you're gonna go ahead, Josh.
Hey, I'm sorry. What do you want us making? Where do you want us making this table, and what are we putting on it?
Page number 9. You see page number 9 at the top.
Yep.
Underneath the word corporation, you'd put 19, 20, 21 and IND. That's on the horizontal, right below the word corporation to the right. And then on the vertical, W/C, C/R, and Q/R. So we can build the table. Does that make sense, Josh?
Sure.
You bet. And then on the IND, the industry, we know working capital is a raw number, so that's NA not available. Underneath the IND for straight across from current ratio, we know the industry comparison, previous page at the bottom, page 8 at the bottom, 2.7. And then right below that for the quick or asset test ratio, 1.0. Okay, now what I'd like to have you do is take page number on each of these. In this case, it would just be page number 7. And you would calculate using the formulas back on page 6. Calculate, use the formulas, use the information from the case study, and plug in the numbers here. Calculate. You can either use your cell phone, or for your calculator, separate calculator. If you have Excel pulled up, you can pop it into there, either of the 3, any way you'd like to do it. Go ahead and fill in the table, if you will. Now, it would be helpful if you put your material in a binder, you could clip out, don't rip out, but just clip out page 7 and 8, because then you'll put them back in later. And your page 7 and 8, you can keep it separate, because as we move forward, it's going to be a lot easier than have to flip back to page 7 and 8, flip back to get those numbers to page 7 and 8, and then flip forward back to the whatever section we're in. It's up to you. but I find with some people, it's easier if you can clip it out, or you could even, if you're near your printer, whatever computer, you're on your computer, but if you can then maybe even print out pages 7 and 8 and hand staple those and just have them separate, it's your choice, whatever works better for you. So go ahead, page 7 and 8, this case is page 7 only, the balance sheet, and take the formulas, and then you'll go ahead, if you would please, and calculate these, and then not only calculate, but plug them in. Plug these in, if you will, into the chart that we've created, the little table we've created. Go ahead and take a few minutes and do the calculation for all 3 years. All 3 years, please. Pardon me. So you're going to do the working capital for 19, 20, 21. You're going to do the current ratio for all 3 years and the quicker asset test, please. Using the formulas and, of course, using the case study. And we'll come back together and make sure that we're in sync. I've got my answer key here. And then, of course, we'll have you shout out some of these answers and away we go. You bet. Pardon me. If you have any questions, just ask, just to clarify any questions. If you'll take Snyder Corporation, take the formulas, calculate these key ratios, plug them in, if you will, and just, you'll have the table completed. And we'll do this for all 5 steps of the Laylock model using Snyder Corporation, the small manufacturer up in the Houghton market. You bet. Owned by one person, Sawtooth, Snyder, and the CFO is Beth. George is in Marquette, the CPA. George has clients pretty much most of the UP, not all, but good section of the UP. George does. Just in the moment and complete the table, if you would, please. Okay, here we go. Olivia, can you give us the working capital for the 3 years, please? Would you be able to give us the 3 years for the working capital, the numbers?
Yeah, so right now in 2019, I got $1,605,600 for 2019. 2020, I got $617,842. And then I'm falling a little behind, but I'm just getting that last one calculated now, which is $1,640,312.
Okay, good. 2 of the 3 are correct. The 2020 is 617,842. 21, 1,643,312. But if you can double check your first number, that first number was off the first year for 19. If you can double check. Go ahead, take just a moment and double check that number if you would.
I probably just pulled from the wrong place or just added it.
Pardon me.
Yeah, 642,400.
Got it. Correct. So the working capital for the 3 years, 642,400, 617,842, and the third year, 1,640,312. Good. All right. Okay, Josh, do you have the current ratio for the 3 years? If you do, if you can give us those, please.
I got 2 of the 3, and I'll calculate the third one as I go here. For 2019, I have 2.33. 2020, I have 1.47, and then $2.58.
You are right on the money. You're right on the money. 2.33, 1.46, 1.47, rounded, what have you, and 2.58. 2.33, 1.46, 1.47, 2.58. Excellent. Take just a moment and complete the quicker asset test. Take just a moment, and Olivia, I'll ask you to do that once you have those. The 3 numbers, for the period for the 3 numbers for the quicker asset test. When you get those, if you'll shout those out, please. So the current assets minus inventory divided by current liabilities. Take just a moment. Everybody, take just a moment, everybody, and finish up that third one. Okay, Olivia, do you have those 3? Yeah, do you have those 3 calculated?
Not yet.
Keep going,
I'm
keep
so
going,
sorry, I'm a
keep
little
going.
slow.
That's all right. Keep going, keep going, keep going. Take a moment, take as long as you need. You bet. Take as long as you need on that third one. So current assets minus inventory. And whatever that number is, then divide that number by current liabilities. You bet. Take just another moment or so. We'll summarize these. Okay, Olivia, do you have the first year for us? The first year for the quick.
I actually just got all the. As far as I know, I probably did my flight calculations wrong. I got 1 across the board.
You got, okay. All right. What?
1 for 2019, 1 for 2020, and 1 for 2021.
Okay. Not 1. So, okay. Josh, what did you get for the first year?
0.85.
0.85. Good. So going back, Olivia, you should have for the quicker asset test, you would take the current assets I'm just turned back to page number 7. It would be the 1,124,000. So current assets minus, this is the first year, inventory of 715,200 divided by the current liability 481,600. Did you see that?
And now I got it. I just think my calculator was just rounding up.
Oh, gotcha. That's what happened.
That's
Okay.
probably what happened. So
Okay.
because I got
so
the answer now.
Got it. You got 0.85. Good. Okay. Josh, what did you get for the second year for a
0.5.
quicker asset? Go ahead.
0.5.
0.5. Excellent. 0.5. Okay. Olivia, do you have the third year for us?
Yep, just wrapping that up right now. And I got 0.93.
You were right on. You were right on the money. 0.85, 0.50, 0.93. Now, for some people, it's like, wow, we're really getting into the calculation. Lot of credit analysts and loan officers, they make the mistake. This is just an idea. They make the mistake of relying upon, for example, Josh, you have credit analysts that will prepare or spread the numbers for you. Well, they make the mistake in that they get so used to someone just providing the numbers to them that it's helpful to understand the actual formulas, because sometimes when you see the spreadsheet, it's like something's off. You now have the formulas you can manually calculate, because sometimes it goes back to GEICO, garbage in, garbage out. The analyst spreads the numbers or they input the number wrong, and it happens. If you've got the financial statement in front of you, you could manually do a little double check, if you will. Does that make sense, Josh?
Yep.
You bet. And Olivia, if you're spreading the numbers the same way, I used to spread the numbers when I was on your side of the table years ago, and I would sometimes I'd spread the numbers and I'd read the spreadsheet, the printout, and I'd go, something's off. And I would calculate manually and go, whoa, wow, I know something's off now. It doesn't match. And then I'd look back on the spread, I'd look at the financial statement, I'd say, oh, wait a minute, I input the number wrong. Garbage in, garbage out. Okay, now we have the table completed now. We have the table completed. What we're going to do now is we're going to go from calculating to interpreting. You'll notice where it says comment on the company's liquidity position. Off to the right of that, off to the right of the word position. After you look back at the numbers, look at the chart, look at self to self, look at self to industry. This is a comprehensive comment or interpretation. Overall, Snyder Corporation's liquidity, how would you rate it? Now, this is comprehensive, meaning not just one number or one set of numbers, the whole table, self to self, self to industry. Overall, would you rate Snyder Corporation's in your interpretation? Strong, moderate, or weak? Strong, moderate, or weak? You could even do a little hedge in between, like weak to moderate, moderate to weak, moderate to strong, strong to moderate. Overall, if you look at this, look at self to self on each of the categories, look at self to industry on 2 of the 3 that we have. How would you rate Snyder Corporation's or interpret their liquidity? Strong, moderate, or weak? You can do a little hedge if it's appropriate. Because a few of these, all right, few of you are going to say, you may say, oh, kind of in between. Take just a moment and write it down to the right of the word position after you've looked at the overall and interpreted. Strong, moderate, or weak, or a little variation thereof, or a little hedge, if you will, in between. That's appropriate. Take just a moment, please. Now we're interpreting. We calculated. Now we're interpreting the numbers. And I find, boy, when I used to spread the numbers, boy, you get going so fast. Sometimes garbage in, garbage out. That's why the underlying financial statements are so important. But even if we're spreading the numbers or having the numbers spread for us, you look at the number, that's not right. Calculate it, get with your credit analyst. Hey, can you redo this? Oh, okay. We all make mistakes, all make input mistakes, output, so forth. Okay, here we go. Josh, how would you, what would you comment? How would you comment or rate Snyder Corporation's liquidity? Strong, moderate, or weak, or a little hedge in between?
Moderate to weak.
Moderate to weak. Okay, thank you. Olivia, how about you?
Yeah, I would have to read it. It's just slightly below that moderate line. I mean, it's meeting industry standards, but
Okay.
well, not standards, averages, but I mean, it's just a little on the weaker side compared
Okay.
to the rest of the
So
industry.
moderate to weak. Okay, good. My personal opinion, I would say moderate. I would say moderate. That's my opinion. Everyone's going to have a little different take. You'll have one take. Your team leader in real life at your bank will have another. And your credit administrator may even have a third take. That's common. And as you negotiate with Sawtooth and Beth, his CFO, oh, well, that could even be they may have a different version. Okay, excellent, excellent.
Hey, David, I got a question.
Go ahead.
Why would you say moderate versus moderate to weak when, 2020 was
That was a tough
down-
year.
It was a tough year.
That was a tough year. If we excluded, good question, Josh. If we excluded 2020 and say that's an anomaly, if we know that, then I would say that's a moderate overall. That's a moderate. Now, I will say this, Josh. What would be extremely helpful is to have a fourth column, meaning interim 6/30 of 22. Would you agree with me? If we had 6/30, now you notice on purpose, I don't have an interim statement to make it a little more challenging, a little more, because you say, well, why? Well, because in real life, you don't always have, as Olivia, you mentioned this, you don't always have current updated financials, and you're expected to make a decision. Well, and that's kind of why I do this. The same way you'll notice in the industry comparisons, we don't have all of them. And that's on purpose, because in real life, you don't always have all of the information. Now, I mentioned I'm a college professor. Well, the case studies within most textbooks that I teach from over the last many, many years, they're always perfect. They have all the information. They have all the industry studies or comparisons. It's just, and the businesses are always profitable. There's never a loss. And you're like, in real life, that's not the real world that we live in. Would you agree with me, Josh?
Correct.
You bet. Okay, good questions. Good feedback. This is what we want. Excellent. Okay, now we're going to shift. We're still in liquidity, but we're going to go. This is one, not all 5 steps of the ladder lot model. Do we have, the the principal or the owner kind of tie-in, but we do have for liquidity and several of them, not all 5, but several of these we do. Snyder Corporation is owned by James Sawtooth Snyder. Now, where in the world do you get that nickname? Well, he's not from the UP originally, from Michigan originally, but he went to school at Michigan Tech in Houghton. He was a mechanical engineering major. Okay. You say, well, and he started working part-time at this small manufacturing firm, like an internship in the Houghton market. And after graduation, the original owner came to him and said, hey, I want you to stay on. Well, 15 years later, the owner eventually retires and has no one to really leave the company to, sell it to, whatever. And he says, hey, Sawtooth, would you be interested in buying oh yeah. So they work out a buy-sell arrangement. Sawtooth almost becomes like this original founder, the original owner, almost like his son or son-in-law, whatever. I mean, it was that type of relationship. So he sold him the business. Well, where did he get the nickname Sawtooth? He's not originally from Michigan, not originally from Houghton. He's originally from Idaho. Idaho. Well, in Idaho, there is a mountain range by the name of the Sawtooth Mountains. There is a famous ski town in the Sawtooth Mountains called Sun Valley, Idaho. It's been there forever, if you will. Famous ski town in Idaho. So when he first went to school in Houghton at Michigan Tech, the people said, well, where are you from? I'm from Idaho. I'm from the Sawtooth Mountains in Idaho. And they just saw Sawtooth and they thought it was a funny name. And they just started calling him Sawtooth. And, this is like 30 years ago when he was in school, because, he's now, in his late 40s, early 50s, whatever. Sawtooth is. And the founders passed away and so forth. Well, George, his CPA in Marquette, prepared a financial statement, showed that he has $205,000 personally in liquid assets and liquidity. Now we've already done the business liquidity. Now it's the business owner / guarantor, Sawtooth. Well, just looking at these numbers, looking at these categories, does he really have 205 in liquidity? Absolutely no. Okay, let's do this. Let's do this one as a class. To the right of cash, over in that blank section, over to the right, and then just one line up, if you will please put in your notes a percentage sign. And then to the right of that, a dollar sign. So we're going to have two columns to the right. One is the percentage, the other one is a dollar sign, or dollar sign and the dollar column. Let's do the first one together. If he has $25,000 in cash and he banks with us, we can verify it. Or if the 25,000 is with another bank or brokerage firm or whatever, and he's got 3 months worth of statements, we'll go with it. Most commercial loan underwriters today nationwide would say, well, what percentage over to the right would we give him credit for this? 100%. I put 100%. Pardon me, 25,000 times 100% over to the far right under the dollar column, $25,000. 25,000. Okay, now I emphasize, we are not taking any of these assets as collateral. No way. None of these assets as collateral. We are assessing or underwriting Sawtooth's liquidity personally. Okay, now, for example, the IRA, you can't take it as collateral, but he has the ability to break the IRA. Look at mutual funds. What percentage, whatever percentage you would give him credit for, you'll take the 15,000 times the percentage and the raw number to the right. Individual unlisted stock. This is stock not on the New York Stock Exchange or NASDAQ. This is stock ownership of a friend of Sawtooth's that owns a company right around the corner from his office warehouse facility, meaning Snyder Corp. What about the IRA? Sawtooth is, like I mentioned, late 40s, early 50s. Boy, if he breaks the IRA, not only is there tax, but there's a 10% penalty because he's not 59 and a half or older to where you break the IRA and there's no penalty. But he's only, roughly right around 50 years old. Okay, go ahead. We did the first one. Do the second one, mutual fund, unlisted stock, IRA, take a stab at this, do the percentage and then do the math over to the right ultimately, you'll have all the numbers to the right, the raw numbers, add up those numbers. The hint is it's definitely going to be below 205. But what is your number? Take a moment or so, take your calculator. What percentage would you give them on the mutual funds, unlisted stock, IRAs? Do the math, carry the numbers to the right, and then total the right hand, the second column over on the far right. What is your total dollar amount? Okay. And every bank's a little different on this, although we'll talk about in a moment, there's some pretty general or some common, I should say, numbers, if you will, amongst commercial lenders nationwide on this analysis. But it could still vary. Every bank's a little different. Every setting, even within a bank, is a little different. Could be. Go ahead, if you would, please. So you take the mutual fund, whatever percentage, whatever that percentage is, times the 15,000 number to the right. What do you think on the unlisted stock percentage times the 75,000 number to the far right? Same with the IRA number to the far right. And then
David, I'm
add up
having a
that
hard time. I just got a quick question. I'm having a hard time. Where are you pulling these percentages? Are you just taking a stab at them?
We're just taking a stab at it. The percentage. What? No, remember, Olivia, we are talking liquidity, cash,
Okay.
or near cash. So how much credit would you give him for the 15,000 mutual fund? Some people say 100%. Most people say no, 75, 80, maybe 50, because there's tax consequence. There's variations in the stock market, which we've seen, of course, extensively. So what percentage? Unlisted stock is not on the New York Stock Exchange or NASDAQ. How about the IRA? If you break the IRA, there's tax and there's the 10% penalty in this situation because he's not 59 and a half or older.
Yep.
So take a stab at the percentage on each. And we did the first one together. Cash, of course, is, you can verify that. That's 100%. Most people would say. Okay. Take a stab at it. You bet. Oh, no problem. Some of this is your interpretation. Some banks, I will say it straight out, Olivia, some banks, credit administration says, oh, if it's cash, it's 100%. If it's mutual fund, it's 75 or whatever. They tell the lenders. But most banks, including community banks like you both are at, most banks, there's some leeway depending on the circumstance. So they're not as rigid as, well, this is exactly the percentage we're going to use for each of these categories. It's not as detailed. It's more up to the lender, the underwriter. Because there could be situations that, in this case, Beth, Sawtooth CFO, tells you about. Well, George calculated, he did the financial statement recently and came up with 205. And then you talk with Beth, the CFO, and maybe it's interpreted a little differently. So most banks are more flexible to match real life. Some banks I've seen, though, the credit analyst, loan officer in this class, and they'll say, well, in my bank, they tell us exactly what the percentages are. Whoa. Most banks a little more flexible to address the real world, the real situation with Sawtooth. Okay, take just another moment, put the percentages, do the math, and total the right-hand column, please. What percentage? Take a stab at that. And then once you do the percentage, just do the simple math and total it. Do the column and then total the column, if you would, please. While you finish this up, look at the comment down below. Why do we care about the owner or the principals / our guarantors liquidity personally? Well, it becomes a backup. It becomes a source of repayment on the loan for our bank. They're backing up their deal. It's one of the two major strengths of a guarantor, financially speaking. Number one, liquidity. Number two, their real estate holdings, the equity in their real estate, whether it's their house, piece of raw land, or even the building. Pardon me. Okay, Josh, do you have your total number?
Yes, I have 164,500.
164,500. Thank you. Olivia, do you have your total number?
Yeah, I'm actually right in the same ballpark of 164,800.
Okay, thank you. Let's do this together. We'd said cash is 100%, so 25,000. Olivia, what did you put for the percentage for the mutual fund?
I put down 80.
80%. Josh, what did you put for the mutual fund?
80.
80. Most underwriters will do either 80 or 75. If you did 75 times that, you're going to be at 11,250. Okay. All right. So 75% times the 15,000, 11,250. So you could use 75 or 80 or what have you. Well, I use 75. But 80 is good. 80, 75 right in there, right on. Josh, what did you say for the unlisted stock?
80.
80. What did you put for the unlisted stock, Olivia?
I put 84.
84%. The correct answer for most underwriters, there could be an exception, but most is 0. 0%, 0 raw number. Whoa. What do you mean by 0? The reason why it's 0 is because of the timing. Unlisted stock is not, I said it, is not on the New York Stock Exchange. It's not on the NASDAQ. It's not. It's ownership in his friend's company around the corner. I'm not saying it's not worth anything. One of the two community banks I worked at, I was able to buy stock. In fact, the bank was brand new. I helped start the community bank, literally started from scratch, went out, raised the capital and worked with the regulators and opened the doors of the brand new community bank. Well, not to be personal, my wife and I bought into the bank. I mean, I was on the foundation of the bank, the start of the brand new bank. At the time, it was considered unlisted stock. So from an analysis standpoint of personal liquidity, for 3 years, it was considered 0. Why? Well, because there wasn't a market. If we had to liquidate it, there was no one to buy it. 3 years later, the stock converted to publicly traded New York Stock Exchange stock. I knew this. It was part of the game plan from the very start of this community bank, brand new. I knew it, and I told my wife. I said, "Well, for the 3 years, it's not liquid. It's no cash. We can't get any money out." But and the projected was about 3-4 years, and it happened within 3 years. It rolled up to or converted to publicly traded stock on the New York Stock Exchange. If it would have been, I would have said 75 or 80%. In other words, once it became publicly traded, in this analysis, similar to the mutual fund. But because it's unlisted stock right now, in this example, in this case study, it's 0. By the way, what did we do? Not to be personal, what did we do with that stock once it became New York Stock Exchange stock? 3 days later, liquidated it 3 days later. Biggest mistake on the planet. Why? If we would have held on for another 4 years, the stock went up by 4 or 5 times. Wow.
Okay.
But initially, unlisted 0. Does that make sense, Josh?
Yes.
Does that make sense, Olivia? That whole discussion?
Yep.
You bet. What about IRA? Josh, what did you put for the IRA? IRA, what percentage?
75%.
75. Olivia, what did you put for the IRA?
72.
72. The answer is typically. And once again, some of these you could debate. Typically 50%, 50%. Whoa, what do you mean by that? Well, there's the 10% penalty because Sawtooth is under 59 and a half. It's around 50, late 40s, early 50s. Number one, 10%. Number two, the amount of tax could be as high as in the mid 30s plus 10, 45%. To be conservative, 50% typically, 50%. If you do 50%, 45,000 off to the right. If you add up the column, 81,250, which obviously is a way lower number than 205. Questions on this? Olivia, questions on this?
No, it's making good sense.
Thank you. Now, at the bottom of this page, if you'll put in your notes, let's add 3 additional assets. Now, these are just some liquid assets that you would see on the personal financial statement prepared by the CPA or even Beth Sawtooth CFO in Houghton. Here are just 3. I mean, there's many more, but here are 3 additional that you'll see. Number 1, no particular order. Number 1, bank CD, bank CD, certificate of deposit at your bank. Here's number 2, a note receivable. Sawtooth gets a call, and he gets a call from a family member back in Idaho. And they say, oh, grandma passed. Oh, okay. So he goes out to the funeral. He comes back a month later, gets a call from his cousin. His cousin calls him one night and it's like, and of course it's late because, you know, mountain time in Idaho versus Eastern time. Okay, zone. So it's real late. And he goes, oh, and the cousin calls. Hey, by the way, did you know Sawtooth? Of course, he calls him Jimmy because he was always Jimmy to the family in Idaho. Jimmy, did you know you inherited grandma's house? What? He's going like, what? So he goes back to Idaho, he takes the time, goes to Sun Valley, the town, sells the house. He says, well, I'm just going to sell it. Someone buys it, but they say, we're going to put 50,000 or 75,000 down. But would you carry the paper? Will you be the bank? Oh yeah, I'll do it. But not on a 30-year mortgage of 15. Oh, we wanted 15. Well, if the note is seasoned, meaning at least 2 or 3 years or more, not brand new, you can consider that liquid. We'll come back to the percentages in a moment. Because he gets in a bind, or if he just wants to get rid of it, he can sell the note. There are companies nationwide that will buy up that note, and they become the bank for that owner of the house in Sun Valley, Idaho. Scenario number 3 or third category, just VA, stands for variable annuity issued by an insurance company. Variable annuity is it's kind of a form of retirement. It creates an annuity once the person goes to retire and they draw on the annuity. Okay. So we've got CD, bank CD, note receivable that's seasoned at least 2 or 3 years in on the 15 years, so we can count it. And number 3, the variable annuity. What percentage, Olivia, would you give them for the bank CD? What percentage would you give them? Just take a stab.
Well, it's all depending, and the big thing is it's all depending on when they pull it as well.
Oh,
because if it's pulled at a maturity rate.
Oh, you're hitting it right on the head. Keep going. So what percentage would you give them?
At this point in time, depending on how big it is, when they're pulling it, say if it's like 75% matured, I would give them at least, I would say like 70%.
Got it. Josh, how about you on that bank CD? What would you give them?
I'd probably give them a little higher. I'd probably give them like 85 to 90%.
Okay. In most situations, it would be 90% because they can get 90% out, but there is the 10% penalty for early withdrawal. With one exception, if, and I hear what you're saying, Olivia, on, the maturity and so forth, but one exception, if the CD is at your bank, you have the ability to get the 10% waived, the penalty. So most commercial underwriters today will either do 90 or 100%. Olivia, does that make sense?
Yep.
Got it. Okay, what about the note receivable on the house in Idaho? He holds the paper. Every month there's a check and here's the payment on the house. But remember, if he sells that note to one of these investment companies, then they advertise on TV even. They're going to discount it, of course. What percentage would you give them, Josh, on the note receivable?
In simple answer, I guess, would be probably 75%.
75. Olivia, what would you give them on the note receivable on the house?
On the house with it being its season. Yeah, I was sitting at 75 to 80%. Well, with it being a house, 70 to 75%.
Got it. Most underwriters, commercial loan underwriters today, 50%. Whoa, 50%. Why? Because those companies that buy that note, they may discount it as deep as 50%, believe it or not. Now, of course, Sawtooth would negotiate and try to get 70, 75, 80%. But from a conservative commercial loan underwriting perspective, 50%.
Why do they not take into consideration the fact that he might just sell the house outright eventually?
Well, no. Remember, he's already sold the house. This is the note. It's not a rental. No, when he traveled back to Idaho to Sun Valley, when he found out he inherited the house, he says, "Well, I'm not going to rent it. I don't want a long distance rental." Yeah. See,
gotcha.
I know, and I do the same. Sometimes I go, "Well, he's renting." Oh, no. He has physically sold it to someone who put 50 or 75,000. They came to him. They saw the for sale by owner on the front yard, and they said, and especially in today's strong real estate market, they said, they called him. In fact, he didn't get out of town, and they called him. Hey, can we meet? I mean, that's how quick. Hey, let's go meet. Let's go meet at Starbucks. Have a cup of coffee, and they negotiate the deal. And they said, hey, my credit's slaughtered. This is the new buyer, the new owner. My credit's slaughtered. I went through a divorce a few years ago. Would you consider carrying the paper? I'm going to give you 50 or 75,000 cash. Oh, I'll do it. But now all it is, it's an asset to him. It's cash. Or to a form of cash. It's a note receivable asset. He doesn't own the home. Number 3, what about the variable annuity? It's a form of retirement. It's an insurance company issues these, and they will, once they're activated, send a check every month to Sawtooth when he goes to retire in several years from now. Olivia, what percentage would you give him? It's a form of a retirement.
I'm going to go with more like 60% or 50 to 60.
50 to 60. Josh, how about you?
Well, they can't. It's a form of retirement. They can't cash it out, can they?
Oh yes, at a discount. Oh yes.
Then I would say 50%.
You were both right on the money. 50%, conceptually similar to the IRA. It's a different type of instrument. The IRA is pre-tax dollars, whereas the annuity is post-tax, but the growth is tax deferred. But you both hit it, 50%. Moving. Well, one last one, tongue in cheek. A 1965 cherry red Mustang convertible, mint condition. What percentage, Josh? Mustang, cherry
30%.
red,
30%.
30%. Olivia, what percentage?
Yeah, I'm gonna shoot low on that one. If it's in mint condition though, 45 to 50.
The answer is 0. The
Okay.
reason why is because the liquidation. Can you get it? That's much more, it varies much more than these other assets. But if I had the cash, I'd buy it in a second personally. It would be 110% in 1 hour if I had the cash to buy it. I mean, those could be 50,000, 75,000 today, easy, depending on the level. Wow, moving right along. Now let's go ahead, take our second 5-minute break of the morning, and then come on back and we'll do model number 2 activity. Excellent, excellent analysis, by the way, team. This is good. Talk to you in 5 minutes. Talk to you in 5. Thank you. Welcome back, everyone. We'll take just a moment and get started. Take just a moment, if you would, please. We'll go into model number 2 of our 5-step activity. Okay, Olivia, are you with us? Are you back with us? Can you do our sound check?
Yep, I'm good.
Thank you. Excellent. Josh, are you back with us? Josh, we'll wait just a moment for Josh. Just a moment more.
I'm back.
Excellent. Thank you. Okay, now activity model 2 definition. We said this earlier. Turn factors or swing factors. They turn up, they turn down. They swing up, they swing down. Okay, now 3 calculations. AR turnover, accounts receivable divided by sales times days in the period. You take the AR from the balance sheet divided by sales on the income statement. That's the first part of the calculation. And then whatever that number is, you times it by, in this case, 365. Why? Because we're using annual 19, 20, 21 numbers. AP turnover, accounts payable on the balance sheet divided by cost of goods sold on the income statement times 365. But you do the first key ratio, the first ratio first, then you times whatever that number is times 365. Third, inventory turnover, inventory divided by cost of goods sold. Do that first, times 365. If we had an interim statement, 6/30 of 22, we would times it by 180, 182. If we had a quarterly statement, it would be times 90. But these 3 today are all annual, 365. Okay. Now to the right of AR turnover and one line up in that blank space, if you would please put 19, 20, 21, and IND. We're just going to build the table. Now, 19, 20, 21, IND for industry. Underneath the industry for accounts receivable is 32 days. If you look back on page number 8, just back in that industry comparison at the bottom. Okay, so 32 days. There is no industry comparison for AP. So I would put NA, not available, underneath the IND industry column to the right. Inventory is 6.1 times on page 8. Now, when you do these calculations, and I'd like to have you do all 3 years, all 3 calculations, the inventory numbers, you're going to see raw number, you're going to see days. You're going to go, wow, that looks totally different than the 6.1 times, and it should. The industry is in times. What you're calculating for inventory turnover is days. Same with AP, same with AR. We're going to come back later as a class and adjust the inventory so we can compare it to the 6.1 times. Go ahead, spend just a few minutes. Look back. We've got the formulas. Look back on page 7 and 8, the balance sheets and the income statements, and complete the calculations. Fill in the table, if you will. Take a few minutes and fill in the table. We've got the industry already to the right. Now fill in, please, 19, 20, 21 for all 3 of these calculations. We'll come back together. And also, by the way, only calculate to the second decimal point. I wouldn't go more than 2 decimal point in. So if your calculator is set on 3 or 4 decimal points, just go to the second decimal point at most. Pardon me.
I do have a question, David. So
go ahead, Olivia.
Is it AR divided by sales times the day in the period, right?
And the first thing you do, Olivia, is the accounts receivable in the balance sheet for that year. divided by the sales from the income statement. You do
Okay.
that first.
Okay. I was just making sure.
Yeah, you do that one first.
And then
you
times by the day in the
and then you
period.
get that number, and then that's times 365. Some people will do like AR, and it gets mixed up because it's like AR times 365 divided by sales. No, it's you've got to do the first part first. You bet.
Okay, I just wanted to make sure because
No,
the way it's written, it says sales and you times the sale by the day in the period.
Yeah, no, it's the first part of the equation, and whatever that number is, then times that number times 365. Good. Excellent.
Sounds like a plan.
You bet. Okay. So go ahead and fill in the entire table, all 3 years, all 3 key ratios, if you will, please. Just go to 2 decimal points at the most on these, on all 3 of these for all 3 years, please, as you fill in the table. Pardon me. And once again, we're doing the number crunching because, even though you use the spreads, and we'll look in our second case study is a spreadsheet where we're not doing the calculating, we're just pure interpreting. But so many times I remember being on your side of the table as the lender, and I'd look at the spread and I go, and I had a whole pool of credit analysts or people that would be spreading the numbers, and I'd say, this doesn't look right. And I'd get on my calculator and the numbers, that's not right. Send it back. They redo it. Oh, now it's correct. It garbage in, garbage out. They put the wrong info in, wrong output. Take just another moment or so. Go ahead, complete the entire table, all 3 calculations, all 3 years. We'll come back together. Take just a moment, if you would, please. You can see we're using page 7 and 8. If it's helpful, you can clip it out or even, print those out, what have you, just to keep them separate. A lot of people like to have them separate because instead of having to flip back and forth, but some people don't mind it. Some people say, I'll just flip back and forth, grab the numbers and do the calculations. You bet. Okay, Olivia, do you have all the numbers yet?
I'm just finishing up on 2021 accounts payable and inventory turnover.
Okay, well, wait just a moment. Josh, how are you doing in the numbers?
I'm all set. I'm questioning my inventory, but I'm all set.
Okay, you bet. We'll wait just into the moment and we'll summarize. Oh, Olivia,
All right,
we
I think
can.
you're good to go.
Oh, good. We can hear your calculator.
I'm so sorry.
No problem. No problem. Okay, here we go. Olivia, what did you get for AR turnover? And let's just round the days instead of doing, even though I said do it to the 2 decimal point, what did you get if you just rounded those days for the 3 periods, please?
I hope I'm right because right now, 2019, I have 37,
Okay.
39, and 45. So
You are
the
right
founders-
on. You
Okay.
are right on. 37, 30, 39 or 40 rounded, 45, 46 rounded. Do you agree with that, Josh?
Yep.
Josh, good, excellent. Josh, what did you get for AP turnover rounded each of the years, please? Each day, each period, please.
19, 24, and 23.
Excellent, excellent. Inventory turnover. Olivia, what did you get for the 3 periods, please?
I got 91, 94, and 108.
You were right on. 91, 94, 108. Now, to do the comparison to the industry for the inventory is stated in times per year. Well, if you have a company that turns its inventory every 6.1 times, that's about every 60 days. 60 times 6 is 360. So to equivalate it, let's do this together as a class. The first year, take 365 divided by 91. And it should give you approximately a 4.0. 365 divided by 91 gives you 4 times. The second period, the second year, 365 divided by 94 gives you 3.87. 365 divided by 94 gives you 3.87 times. The third year, 365 divided by 108 gives you 3.38. 365 divided by 108 gives you 3.38. Now, let's look at the big picture. We want receivables traditionally to either maintain or shrink in number of days because they're collecting their cash quicker. Payables, we want those to stretch out, but not so far to where the company gets put on what's called COD, cash on demand, cash on delivery. But boy, this company is paying their bills, their payables too quickly, especially relative to their receivables. They're getting stretched out on the money coming to them, but the money they're dishing out, whoa, too quick. What about the inventory? In number of days stretched out, not a good thing. Or if you look at the number of times, we want number of days to shrink, better utilization, better turn of the inventory, or if it's times, more times. Well, what's happening to times? It's shrinking. 4 to 3.87 to 3.38 versus 6.1. Whoa. Same idea. Whether it's days or times on the inventory, it still shows us the same general trend. Okay, now down below on the comment, you'll notice, look at the big picture of the chart. Industry comparison, 32 days on the AR, not available on the AP. Inventory in times 6.1. We want more times. There's a shrinking, and or days expanding, same idea, just the flip side. Days versus times per year. How would you comment on Snyder Corporation's activity overall comprehensive model? Like we did on liquidity, but it's a comprehensive viewpoint. Strong, moderate, or weak, or a little hedge in between. Go ahead, take a moment, look at the chart, comprehensive comment down below. Comprehensive comment down below. What would you say? Write it down. What would you say? Olivia, we'll start with you. What would you say?
Part of me says I want to say moderate because, like, as the year, like 2020 is such an awkward year that we can't really,
Yeah.
we can consider it, but it's so hard to consider it because it's such an anomaly.
Yeah.
But I mean, over all 3 of the years, like the number of days have been getting larger, but also at the same time, he's been making more sales. He's been making a profit in the aspect
Yeah.
compared to the last 2 years. So I like
Yeah.
to say like a moderate.
Moderate. Okay. Thank you. Josh, what would you say? What would you say, Josh?
Weak.
Weak. My personal opinion is weak. Weak. And I hear you though, Olivia. I hear you. He's still growing in sales and he's back profitable the 3rd year. But overall, AR stretched out, inventory stretched out, AP too tight. Wow. Thank you. Excellent. Now we're going to take this like each of these, most of these laylock models, we're now going to go into an expanded, in other words, extension from this model. So we're still in model 2 activity. If you'll turn the page to page 11, this is called the cash conversion cycle. This oftentimes you do not see in commercial loan underwriting, but when you see it, you're going to go, whoa, I'm going to add this to it, which you should, in my opinion. In other words, we're still in the realm of model 2 activity. It's called cash conversion cycle. How do we define it? If you put the definition there, please. The average number of days that the company's cash is tied up in its current assets. The average number of days that the company's cash is tied up in its current assets. Average number of days that the company's cash is tied up in its current assets. We want this number to either maintain from year to year to year, or even preferably shrink in number of days. Better utilization of their cash. Look at the middle paragraph. If you'll read, please, where it says note, just that paragraph, not down below, not above, just that little paragraph. This is the importance of shortening a company's cash conversion cycle. Has multiple benefits. Go ahead and read that middle paragraph if you would, please. Okay, now let's look at the calculation, the formula up above. It's inventory in days that we just calculated, in days, not times, in days. It's one reason why most commercial lenders days for AR, AP and inventory turnover. Number of days inventory turn plus AR minus AP. Inventory plus AR minus AP. If you go ahead, grab your calculator and go back to page number 10. And these are rounded days. Just use the rounded days. And right where it says calculate, if you'd put 19, 20, 21, there is no industry, no IND. But where it says task, put 19, 20, 21. Go back to the previous page. Rounded days for 19, inventory turnover, plus AR turnover, rounded days, minus AP rounded days. And do this respectfully, please, for 19, 20, 21.
Are we
for all
supposed to
3
use
years.
are we supposed to use the actual days or the four, like the 4 times, the 3.8 times?
Oh, no, days. Remember, I said days only,
Okay.
not the times. That's why I said most commercial lenders on the previous for the activity, they'll keep it days, but gets tricky if the industry comparison, Josh, is in times. Does that make sense?
Yeah.
That gets a little tricky, and that's why we did the equivalent just to get a
I
feel for
gotcha.
the times. To stay
Gotcha.
days. This is days. Days inventory plus days AR minus days AP for 19 by itself, 20 by itself, 21 by itself. No industry comparison. Yeah. Sometimes I've done it. I've mixed those two, Josh. Whoa, that meaning the times. Whoa, no. Times and days is the same thing. It's just how many times per year versus how many days. It's the same concept. It's just the two halves. It's just different viewpoints. Same idea.
Gotcha.
You bet. Okay. Do this for all 3 years, if you would, please. Use this form, and I just use the rounded days that we used before. Don't go to the 2 decimal points for the inventory in days, AR in days, AP in days. Okay, Olivia, do you have the first year for us?
Yes. I have right now, I got 110.
You are right on the money. Josh, what did you get for the first year?
109.
Same, rounded, same. Josh, do you have the second year for us?
110.
110, correct. Olivia, do you have the third year?
131.
You are right on the money. So rounded 110, 110, 131. Whoa, consistent. That's good. But then what happened? Stretched out 21 days or 3 additional weeks from 110 to 131. Not a good trend. Remember, I had you read that middle paragraph, that note. Shorten is the name of the game, the name of this key ratio. Wow, they stretched out. Not good. Now look at the bottom left. The company could shorten its cash conversion cycle by doing how? Snyder Corporation reduced the inventory. Beth, the CFO, has been after Sawtooth for the last 2 years. Sawtooth, boy, this is antiquated. The way we process our inventory, the way the raw material comes in the plant, the way it's configured in the plant, and the way it goes out, the inventory gets stretched out in the process. She says to him, we've got to reduce the AR. We've got to stretch out our payables. Beth has an AR manager. He's asleep at the wheel, so to speak. Nice guy, but he plays on his phone all day long. And the AR is stretching out. Oh, at the same time, Beth has an AP manager. She's too good. Sawtooth says, hey, can you slow it down? Meaning slow down those payments. All of a sudden, Beth and Sawtooth are meeting. And they look at each other and say, wait a minute. We have the right 2 people. We just need to switch them. Get the AR manager to get in the payables and let him stretch it out because he plays on his phone all day long. And the AP manager that pays him too quickly, boy, get her in the AR and she'll collect them. To the left of number 1, let's say they improve their inventory from 108-day turn the last year, well, on the previous page, 21. Let's say they improve it and they drop it from 108, if you put to the left of number 1, 80 days. Wow, they could do it. They could easily do it. What about number 2, receivables? Receivables, the last period was 46 days because the new AR manager, oh, she's on it. The AR, let's say, make believe they drop it to 30 days, from 46 days down to 30, which is great. Collecting quicker. And let's say the AP, which was too short, 23 days. The new AP manager, he stretches it out to 35 days if you put 35. 80 days inventory now, AR of 30, AP of 35. Do the math. Everybody, let's do the math. 80 days plus 30 days minus 35 days. You should arrive at 75 days. Olivia, do you have 75 days?
As you hear my calculator going, yes.
Okay, all right. Josh, did you get 75 days on that?
Yes.
Good. That is a 56-day improvement. Wow. Cash conversion cycle. Questions on this? This is an extension of activity. We're still in model 2, but it's an extension, and it's an extension that you only see periodically amongst commercial lenders. But if you look at this is huge, including that paragraph in the middle that really summarizes it, the benefits of a shorter cash conversion cycle. Questions. Olivia, any questions?
No, not at this moment. We're doing pretty good.
Good. Excellent. Let's turn to page number 12. We're going to stop right there. When we come back, we'll work on our third of our 5-step LAYLOT model. Now, took a few minutes past the lunch hour or noon just to finish that last model. Let's come back at about 12:35 your time. That's a fair deal. Let's come back about 12:35, take a half-hour lunch, and we'll come back and continue the saga. Leverage. We'll start with model 3 when we come back. With that, have a good lunch, everyone. Talk to you in a half hour. Thank you. Excellent. Excellent calculating. Excellent interpreting. Good. Talk to you in 30 minutes. Welcome back, everyone. We'll take just a moment and we'll get started. I hope you had a good lunch. Go ahead and get started in just a moment. Okay, Olivia, are you back with us? Can you do the sound check?
Yep, I'm all here.
Excellent. Josh, are you back with us?
I am just stuffing my face for one couple minutes.
All right, no problem. Keep eating, keep drinking, whatever, even during the session. Don't worry. You bet. Take just a moment. We'll get started. Okay, let's go ahead. Our third of our 5-step LAYLOT model. Pardon me. Leverage. Definition. We'll put the definition again. Definition is the company's ability to service its long-term obligations more than 12 months. Even think in terms like we said earlier, 3, 4, 5 years out, long-term perspective. Okay. The key ratio in this one is the debt to net worth or equity ratio. We say debt, we mean total liabilities from the balance sheet. So this one is exclusive balance sheet back on page number 7. We take the current and the long-term liabilities divided by the total net worth or equity of the business. Current and long-term liabilities, that combination, that number, divided by the total net worth or equity of the business. Some people, you'll see, I've worked with some CPAs and they say, well, wait a minute, isn't the debt to worth ratio just the long-term liabilities divided by the net worth or equity of the business? I said, well, traditionally, we want to be more comprehensive, both current and long-term liabilities or debts divided by net worth. Okay, underneath where it says calculate, pardon me, if you will please put in your notes 19, 20, 21 and IND for industry. And then that's right below debt to worth ratio for Snyder Corporation. And then that's on the horizontal, and the vertical to build the little table, D/E, debt to equity, debt to equity. Now we know the industry comparison back on page number 8 at the bottom is for the debt ratio is 2.0. So you can plug that in 2.0, take a moment, go back to use this formula, go to the balance sheets on page number 7 for Snyder Corporation. And if you'll calculate the debt to worth ratio and just plug them in, we'll come back together as a group in just a moment. Pardon me. Calculate the debt to worth ratio, or debt to net worth, debt to equity, same thing.
Hey, David, what you said it included in the debt is the current and the long-term
Yes.
liabilities and the long-term debt?
Total current liabilities plus long-term liabilities combined divided by the net worth or equity of the business. Yes. It's a more comprehensive. Sometimes I find with a few CPAs and a few other financial individuals, CFOs, whatever, and they've been taught, oh no, it's just long-term liabilities divided by net worth. But as a commercial lender, we usually would like, in a commercial lending perspective, more comprehensive, both current and long-term combined, divided by total net worth or equity. Net worth, equity, same thing. Okay, Olivia, do you have the numbers for us?
I have the first one.
All right, well, go ahead, keep going, keep going. Do all 3 years, please. So you're just taking from the balance sheets, page number 7, where it says the current liabilities plus long-term liabilities, those two numbers combined, divided by the net worth or equity. Do all 3 periods, do all 3 years, please. Pardon me. Okay, Josh, do you have all 3 of them?
Yes.
Okay, we'll start with Josh. What did you get for the first year? What did you get?
1.21.
1.21 is correct. 1.21 is correct. Olivia, what did you get for the second year?
I got 4.17.
You were right on 4.17, 4.18. You were right on. Josh, what did you get for the third year?
0.78.
0.78 is correct. So 1.21, 4.18, 4.17, and 0.78. Okay. Any questions on the math? Any questions on the calculation? Olivia, any
Nope.
questions on that? Okay, now before we make our comment, let's just talk about this ratio a little deeper. Well, for example, what does the 1.21 mean for that first year? How do we interpret that? For every $1.21 of debt, there's a dollar equity. There's a dollar equity. How about number two, 4.18? For every $4.18 of debt, there's $1 of equity. Whoa, higher leverage. What about the third year? 0.78. Pardon me, for every 78 cents of debt, there's a dollar equity. Now, how did it swing around so much? Hold your eyes, don't look at your screen, but turn back everyone to page number 7. I'm going to turn on the screen. Now you can look at the screen, look at page number 7 in front of you. Just flip back to page number 7. If you look with me, you can see 19, 20, 21 on the bottom. You can see the current liabilities, long-term liabilities or debt. We have the total equity. But look what happened. That first year is a 1.21. Not bad, not bad. What about 2020? That was the lost year. That was the tough year. They borrowed a lot of additional money, a lot more. Look at how the liabilities grew, the notes payable, the long-term debt. A lot of that was to cover the loss for that year. Okay. What happened in 21? They paid down the debt. Well, how did they do it? Well, if you look at common stock, look at common stock at the bottom left. Look how over to the right when we see the numbers, 460, 460, and 1,680,000 and change. Well, what happened is Sawtooth sold off part of his business. Now, how much would he have sold max? Traditionally, no more than 49%. Why? Well, because if he sells off up to 49%, he still owns 51%. He controls the business. How much money did he raise? You can see the 460,000 up to the 1,680,000, about $1.2 million. Okay. Now I'm going to say it straight out from our perspective as commercial lending. There's a negative, there's a positive. What's the big negative? He violated our loan covenant, a standard loan covenant within our loan documentation for any commercial loan. There is a phrase specifically within the business loan agreement that says you cannot sell off part of your business without the prior approval of whom? The bank. Even though he still controls it, 51% versus 49% ownership. He violated the covenant. That's a negative. But what's the positive? What did he do with the 1.2 million, the 460 up to the 1,680,000? What did he do with the 1.2 million approximately that he raised? Well, look at the long-term debt, $1 million down to 500,000. Look at the notes payable, 720 down to 300,000. So on one hand, we're angry. We, the bank, from a commercial lending perspective, because he violated our covenant, he kind of blindsided us. On the other hand, he was conservative in what he did with the money. He went ahead and paid down the debt. Now, He could have, instead of paying down the debt, which was the conservative approach, he could have taken the 1.2 million, hopped on an airplane, and gone to Vegas. Olivia, how quickly could Sawtooth take his 1.2 million, go to Las Vegas? How quickly could he spend that in any given evening in Las Vegas? How quickly could he spend it?
It's depending on what your time frame, but I would say by 5 hours.
5 hours. Josh, how long do you think it would take Sawtooth to rip through, quote unquote, rip through the 1.2 million in Vegas? How long?
I've never been to Vegas, but I would guess probably within a weekend.
Oh yeah, within a given weekend, he's done. You're both right. I mean, it could be 5 hours, it could be a weekend, but they're done. He's done. Actually, it could even be literally one bet. Las Vegas, we have special rooms in Las Vegas where it's by invitation only. Every bet is $1 million plus. Oh yeah. And people will play all night long. Oh, they'll lose 50 million in the night, $75 million in the night, 100 million in the night. You're going, no way. Oh yes, real. These people are multi-billionaires from all over the world. They have a private jet come and pick them up. Private jet. These people will spend $50 million in one night in Vegas. You may say, no way. Oh no, that's true. That's very true. But he didn't do that. No, he plowed the money right back into the business. Now, because of that, he lowered the debt to equity ratio to a measly 0.78. For every 78 cents of debt, there's $1 equity. That's conservative. With leverage, we want the lower is the better. Back on liquidity, current ratio, remember? No, the higher is the better. Higher liquidity, lower leverage. So let's move forward back to page number 12. If you'll turn your pages back to page 12. Now, we know the industry comparison's 2.0. We know the first two is a 1.21, 4.18, and a 0.78. It's all across the board. Industry standards a 2.0. If you'd be so kind as to comment, but before you comment, let me give you the old-fashioned rule of thumb for this one. A maximum of 3.0. A maximum of 3.0. What's a 3.0? For every $3 of debt, $1 of equity. $3 of debt, $1 of equity. A 3.0. Okay. Self to self, self to industry. Self to self, self to industry. Keep in mind the industry is 2.0. We see the trend. General rule number 1, self to self. General rule number self to industry. And there is an old-fashioned rule of thumb for this one. Max of 3.0, not minimum, max. Not all of these have old-fashioned rules of thumb, but several of these of the 5-step Laylock model. Okay, now that you have the information, you have the chart, comprehensive comment. Strong, moderate, or weak, or a little hedge in between. A little hedge in between. Could be strong to moderate, moderate to strong, moderate to weak, weak to moderate. Go ahead, spend just a moment. Make your judgment call, write it down, and we'll talk about it. Please. While you decide this, could you imagine spending $50 million in one evening? It does happen. Oh, I'm serious. I am very serious. That's not make-believe. That's real. Okay, here we go. Olivia, what is your judgment call? Strong, moderate, or weak, a little hedge in between?
I'm going to say, based on all the numbers and the industry average, I would say they're a medium to strong. Yes, 2020 was high up there, but even then in 2019, there was a 1.2 that's still well below the 3.0 margin max that we like. So I say they're medium to strong.
Moderate to strong. Okay, good. Josh, what would you say? What is your judgment call on this one? Comment on this one.
I'm gonna say
Please.
strong.
Strong. My personal opinion, I'm going to hedge like Olivia and say moderate to strong. And it's because we don't have an interim period, 6/30 of 22, which would be great to see. Do they keep the low leverage position of roughly a 0.78, 0.80, somewhere in that range? Or do they all of a sudden take on more debt? So I'm going to say it's moderate to strong, simply because we have that bad year in the middle, and we've got the next year good, 21, but we don't know about 22. Okay, good, excellent. Each of you, excellent. This is good. Okay, now what about, we're going to step this up. What do we mean by subordinated debt? Well, subordinated debt is this. Subordinated debt is where, let's say that Sawtooth, instead of borrowing from his company, let's say he lends money to his company. Let's say he lends, I'd put underneath subordinated debt, he lends $100,000 to his business. Well, on the business, on Snyder Corporation, we don't see it because it didn't really happen, but let's say he did. It becomes a note payable from the business to him personally. From the business to him personally. A note payable for $100,000. He lent them $100,000. Well, what do we do as a bank? Look under the adjustment. We would say, wait a minute. If everything falls apart financially at Snyder Corporation, our fear as a bank is that he's going to try to personally get in the pecking order of the creditors and try to get paid before us. And it does happen. It does happen in America. Company goes under. This is not publicly traded, privately held. And the creditors, including the bank, they don't anticipate it. And through his attorney, Sawtooth jumps ahead of the bank in the pecking order. What? Meaning for collecting, when the company is liquidated. What? We don't want that. So what do? We have him sign what is called a subordination agreement in our commercial loan documents. It is a standard document. It's called a subordination agreement. But what does that really do? Well, in all intents and purposes, the $100,000 loan that is owed from the company to Sawtooth personally is subordinated to whom? Our bank, your bank. That means in the pecking order, if the company falls apart, who gets paid first? Sawtooth or your bank? Your bank gets paid first because he's signed off that he is behind our bank. Olivia, does that make sense what I just said?
Yeah, no, that makes sense.
Josh, any questions on that?
Nope.
Okay, now if this happens, and you'll see this, you'll see liabilities, note payable to the owner all the time. Some banks will say we want that subordinated. Some banks will say, it's okay. But let's say you do have him sign the subordination agreement for the $100,000 loan. That's, it's a liability in the company name. For him personally, it's an asset, of course, personally. But the company, it's a liability. Well, how does this impact the debt to equity ratio up above? Well, if he signs the subordination agreement, the $100,000 liability or debt on the balance sheet of the company, when you do the debt to equity ratio, you take it out of the debt side and you add it to the equity side. Let me say that again. He signs the subordination. You mathematically take it, pardon me, you mathematically take it out of the debt side of the key ratio up above and add it to the equity. Well, how do you do what? How do you justify that? Well, because for all intents and purposes, as far as your bank is concerned, that 100,000 is no longer a liability to the company, because Sawtooth essentially has said, no matter what, that 100,000 is subordinate to the bank loan, and therefore it's essentially equity. Josh, does that make sense?
Yep.
You bet. Olivia, any questions on that?
No,
Got
it works good.
Good. Okay, now let's add on to this model one more time. Here's another one. DTI, debt to income ratio. Now, this is more of a consumer loan underwriting concept. We take total monthly debt payments on the numerator divided by gross monthly household income in the denominator. The average bank today, pardon me, nationwide, the maximum standard is 43% on this key ratio. Olivia, do you know what your bank's maximum standard is? Not minimum, but max on this.
No, I do not know that number.
No problem. Josh, do you know yours at your bank?
I spent 10 years in mortgage, so it's 43.
You are right on, Josh. 43%, I'd write that down, both of you. 43% is the maximum nationwide today in our entire industry, the banking industry. Now, why all of a sudden do we have this key ratio show up? Well, some commercial lenders, to get a read on the leverage of not the borrower, not the company, but of the principal, the owner, Sawtooth, they will do a personal DTI, debt to income ratio for that individual. Max standard is 43%, as Josh mentioned, and that's standard nationwide. So that's why we've included it in this model, the very bottom. So it's an indication how leveraged is Sawtooth personally. Okay, Josh, no names mentioned, Josh. What's the highest DTI you've ever seen in your entire career?
That got approved, or that was
not approved, just ever.
Oh, I've seen them over 200%.
Yeah, good. What's the highest you've ever seen approved?
Probably. I mean, it's all dependent on their scenario, but 50 to 60.
Yeah, that's about right. 50 in the 50s. Typically, most banks won't go above 50% on the DTI, debt to income ratio. Sometimes I've seen as high as maybe 60, but that's a big exception. Would you agree, Josh?
Yeah, I mean, it's even a 50 is going to be an exception. I mean,
Oh, yeah.
Typically anything over 50
Yeah.
50 is going to be an exception. But
yeah, and most banks even above 43 up to 50, let alone if they'll even go above 50. Good. Now, our fourth of our 5-step LALOP model, operating performance. Let's put the definition once again. The definition is the profitability of the business. The profitability of the business. Now, what we do, as you can see in the middle of this page, we common size the income statement. Well, what does that really mean? Simply put it in percentages. You see the raw number, the net sales, 5 million from the income statement, minus cost of goods sold, 4.4 million, gives us gross profit of 600,000. Raw number. Minus G&A, general and administrative expense, 350, gives us the net profit for 250. This is just a make-believe example, just to illustrate. Now, those are the raw numbers. What are we concerned mostly in this model, model 4, operating performance? It's the gross profit margin, or in this case, 12%, and the net profit margin, or in this case, 5%. So I'd circle or highlight the 12 and the 5%. Our main focus, key ratio wise, is the gross profit margin, which is the 600,000 divided by the 5 million gives us 12%. The net profit margin, 250 divided by 5 million, 5%. Now in accounting, brackets usually mean negative, but in this case, it's just separating it from the raw number to the left. So gross profit, margin or percentage, net profit, margin or percentage. Okay, now what we're going to do, let's turn back, hold your eyes, flip back to page number 8, if you would, in our case study, Snyder Corp, page number 8. Let's go ahead and we're going to calculate these numbers. Okay, now what we have to do, because it doesn't clearly show us the gross profit, you'll take sales minus cost of goods sold to give us gross profit. So the first step is if you will both take sales minus cost of goods sold, what is your raw number? Do it for 19, 20, and 21. That's the first step. Then we'll do the percentages of the margins in this model. So take just a moment, sales minus cost of goods sold gives us our gross profit just for the raw number. Don't do the percentage yet, for the 3 years, respectfully. We'll come back together in just a moment. Pardon me. Okay, here we go. Olivia, what did you get for the first year, please? The gross profit.
2019 gross is 568,000.
Excellent, excellent. Josh, what did you get for the second year for 20?
854, 400.
You were right on. What did you get for the third year, Olivia, please?
1,235,600.
You were right on. Okay, now take the gross profit raw number that you just calculated respectfully for each year, divide it into sales, and it will give you the gross profit margin or percentage. That's the key. We're not as concerned with the raw number as we are with the relative percentages. Go ahead and do that for the 3 periods. Gross profit margin, raw number, gross profit divided into sales, if you would please. Pardon me. What did you come up with? Take just a moment and do all 3 years, if you would, please. Take just another moment on this. We'll summarize. Pardon me. Okay, Josh, what did you get for the first year, the gross profit margin or percentage?
17%.
Excellent. Rounded 17. Olivia, what about the second year, please?
I am so sorry. I had to hand off some paperwork to a coworker, so
Oh, no
I
problem.
haven't had some time.
No problem. Let's take just a moment so you can do 20 and 21. You're just going to take the gross profit raw number divided into sales for the 2 year, the
All right,
last
that's
2
what-
years.
That's what I figured. All right, give me 5 seconds.
No problem.
Alrighty. So for 2020, I got 0.14.
Good. Or 14%. Good. 14.6.
Oh yeah, I'm done.
You bet.
14%.
14.
That would work.
Good. And what
Yeah,
about
14%.
21?
21, I think I might have did wrong, but it's saying I think I pulled that number wrong because it was saying 100%, and I know that's not 100%.
No, not 100. What'd you get, Josh, for the third year for the gross profit margin?
18%.
18% rounded. Good. 17.6 or rounded 18%. Is that what you got, Olivia?
No, I think I'm just typing too fast, though. That could be my only issue. 2, 3, 5, 6. Yeah, that would help if I put the numbers in the right place. So yes, I did get it.
Got it. Okay. Now, one more calculation, and then we'll do our comment on Model 4 operating performance. Look at the net income. You take the raw number net income divided by sales. You do it all 3 years. So if you do that, if you go ahead, for example, that first year, 87,960 divided into 3,432,000. And then, of course, you do the same procedure for all 3 years. Right next to the raw number, if you would put the percentage, which is the net profit margin or net income margin. Profit margin, or pardon me, income profit, same thing. Your net profit margin is, of course, the raw number, net income, divided by sales. What is the number? Take just a moment and calculate all 3 years, if you would, please. And do this to 1 or 2 decimal points, if you would. Do this to either 1 or 2 decimal points, so we're a little more refined on this one. It's going to help us when we do our comment, when we plug in the industry comparison in just a moment. So 1 or 2 decimal points on this net profit margin. Take just a moment, we'll start. Pardon me. Okay, here we go. Olivia, what'd you get for the first year, please?
First year, I got 2.6.
You were right on.
2.56.
No, you were right on. 2.6 rounded. Josh, what did you get for the second year?
Negative 1.6.
You are correct. Olivia, do you have the third year for us?
Not yet. Let me get that going. I am so sorry, guys.
It's all right. It's all right. No, you're doing fine. You're doing fine.
All right, I got 3.6.
You were correct. 2.6 positive, negative 1.6, and a positive 3.6. Okay, so we've done the analysis. Now, as I mentioned earlier, when you see profit margin in industry studies, they're usually referring to net profit margin, 3.6. So if you'll put, this is down below at the bottom of page 8, if you'll put 3.6 off to the side of the 3.6 for year end 21. Now that's the industry comparison for all three periods. Now let's go to our two general rules of thumb: self to self, self to industry. Self to self is the trend of the company relative to itself. Self to industry, those numbers, the company's numbers relative to its industry. We don't have a gross profit margin industry. We do have a net. Pardon me. Let's stay, we'll do the comment right on this page at the, maybe the top right-hand side of this page. Strong, moderate, or weak, or a little hedge in between? Would you say overall operating performance for Snyder Corporation, this small manufacturer in the Houghton market, is it strong, moderate, or weak, or a little hedge in between? Take just a moment, make your judgment call, your comment, if you will. Take just a moment. Comprehensive, how would you rate it? Josh, what would you say?
Moderate to weak.
Moderate to weak. Olivia, what would you say? What would you say, Olivia?
Sorry, I thought I unmuted myself. I would say moderate to weak as well.
Moderate to weak. Okay. My personal opinion, I would say moderate to strong, simply because of the trend, or at least the upward tick. It's not a trend yet, because it's just one period of 21. Wow. That upticks, if you will. 2.6 positive, negative 1.6, positive 3.6. Boy, would you want an interim statement 6/30 of 22? Absolutely. Whoa, what? Okay, let me ask you this, Josh. If you had the interim statement of 6/30 of 22 and it showed a 4.0 net profit margin, would that change your judgment call?
100%. I'd be, at that point, I'd probably be moderate to strong.
Okay. And I'm just going on a limb myself and saying moderate to strong right now. But I agree with you. Now, this just shows the importance, pardon me, of having updated financial information, updated financials, and accurate underlying financial statements. Good. Excellent. Any questions, Olivia, on this? Olivia, on this model 4, any questions?
Not that I'm seeing right now. I think
Okay,
everything's holding on pretty good.
good. Okay, let's turn back. Don't look at your screen. Let's turn forward. We're on page number 13. Now, let's go to page number 14. This is the first of our 3 foundational cash flow models. This is the first of our 3 foundational cash flows. Okay, how do we define cash flow earlier? If you put in your notes next to the word definition, cash in versus cash out of the business. Cash in versus cash out of the business. What's another way to describe it or define it?
Lifeblood.
Ooh, Josh, you got it. Lifeblood of the business. Good, financially speaking. Now, these 3 models are foundational. But when the first is the EBITDA traditional, it's been around for well over 60 years. That's why it's called traditional. Now, if you'll turn with me to page number 15, we're going to calculate this in a moment for Snyder Corp. But let's go now to page number 16, our second major cash flow. We're not going to calculate. We'll save this for the 29th of July in Marquette, ground-based, also Zoom-based. We'll do both, but I'll physically be there. And this will cover actually physically, within the tax class. We'll talk about it even more in depth. And then the third and final cash flow for today is global. EBITDA for the business, personal that's for Snyder Corp, personal for Sawtooth, and the combined. Okay, let me ask you, Olivia, do you work on EBITDA cash flow models today? Have you started to work on these?
Yes, I have been being only 26, I mean, 26, I'm still fresh to the finance industry. I'm trying the best I can with what I
No problem.
got.
But you are starting to work on this in your bank in real life, right?
Yes, debt to service coverage ratio is a huge one I've
Yep.
been focusing on, which
Good.
is influenced with EBITDA.
You bet. Okay, thank you. Josh, do you work with the EBITDA?
Just in the credit request when we're
Gotcha.
discussing it, but this is
Gotcha.
one of my big questions is what does it mean for a company?
Well, we're going to cover that. Josh, do you work ever on the personal cash flow for the sawtooths of the world?
No, that's all done by a credit analyst.
Gotcha. Olivia, have you worked on the personal cash flow for the business owner?
If they provide it,
Oh,
or
got
if
it.
they
I
have
love
any
it.
information on
That's
it.
good.
And I'm really happy to like see this because I'm having a lot of trouble in these aspects.
No problem. We're going to cover these in depth. Okay, let me ask you the third cash flow. Josh, does your bank do global cash flow modeling?
Yes.
Good. By the way, for whatever's worth, starting 4.5, 5 years ago, the federal bank examiners started to insist that commercial lenders within the bank that we include this one. Olivia, have you ever seen a global cash flow?
Yes, based on what I have been able to conjure up with tax
Gotcha.
books. But the beauty of SageWorks is it helps me get all that rather
You
than
bet.
having to handwrite everything.
You bet. You
SageWorks
bet.
is beautiful for that.
You bet. Excellent. Okay. Okay, now let's go back. That's good. That gives us a good feel where you're both at. Now let's look at EBITDA, the first of our big three. These are the foundational cash flow models. EBITDA, traditional, been around for years, as I mentioned. Okay, we're going to do the same procedure on all three of these. We'll go through the model. I'll explain the model, the mechanics of the model, and then we'll go back in and dissect it deeper. So we'll go through the flow, and then we'll come to number one, number two, go back and dissect it deeper. We'll do the same on all three models, so you get a good feel on these three. Let's start with the EBITDA inflow. EBITDA is 1.2 million. Now, commercial lenders use the Roman numeral system often. Instead of putting all the zeros to the side, 1M in Roman numeral system means 1,000, 2M mean a million. So this is 1.2 million, not 1.2 billion. 1.2 million. 1M is 1,000, 2M is a million. If you read the Wall Street Journal and you see M, they mean a million, but that's not true Roman numeral system. For example, in the Roman numeral system, what's a V? Anyone, what's a V? Anyone?
5,
5. What's an X?
10,
10. What's a 1X?
9.
9. Okay, so in Roman numeral system, 1M is 1,000, 2M is a million. So the inflow is 1.2 million minus the debt service, principal and interest P&I, $500,000. The net difference of margin, or if you put the word excess right next to margin, of course, is 700,000. 700,000. 1.2 million inflow divided by the 500,000 outflow gives us the DCR, debt coverage ratio, of 2.4. You must say that again. EBITDA inflow at 1.2 million minus the outflow of the debt service, principal and interest of 500,000 gives us 700,000. Pretty straightforward. But then we take the 1.2 million inflow divided by the outflow of 500,000. That gives us the debt coverage of 2.4. That's the basic flow of the model. Now let's dive deeper, dissect each part. The inflow is the EBITDA. Well, what's the formula? Well, you can see what it really means is earnings or net income, net loss be before interest, taxes, depreciation, amortization. Earnings before, the B is before, meaning we add it back in. We add these, as you can see under the formula. Now we said, so we start, whether we're using the income statement from the financial statement source document or the income statement, essentially the front of the tax return, we start with net income. This is what we're going to do on the 29th. But now today's main emphasis is financial statement. The 29th of this month. Oh no, in Marquette. Oh no. It's tax return as the source document. Either way, it's the same formula. EBITDA. Earnings, net income, net loss, add back interest expense. Why do we add back interest expense? Well, because look up above in the formula. We take out interest, P&I, principal and interest, part of the debt service. Plus, interest expense has already been netted out of net income, net loss from the income statement. Let me say that again. Interest expense is taken out with the debt service, as you can see up above. But it's already netted out of the earnings, the net income, net loss. So we've dinged the cash flow twice with interest expense. If we don't add it back in, we've dinged them twice. Olivia, does that make sense what I just said?
That makes 100 times more sense on paper.
Okay. Josh, does that make sense?
Yep.
Okay, now, so that's why we add the I back in. What about the T of taxes? I put a little note above the T of taxes. This is only a C corporation, which is a tax-paying entity. An S corporation, an LLC, partnership LLC, those are non-tax-paying entities. Those are what we call pass-through. The tax passes from the business to the business owner, only taxed once at the business owner level. Whereas a C corporation, oh no, it's a taxable entity. In a C corp only, we add taxes back in to the EBITDA. The reason why is because taxes in taxes in a C corp are considered non-operating expenses. Pardon me, non-operating expenses. They're after the normal operations of the company, the payment of tax. So they're an outlay of cash, but they're after the normal operations. So we add it back in a C corp only. Remember, in an LLC, S corp, there is no tax, meaning income tax. What is depreciation? We depreciate vehicles, equipment, and buildings. Vehicle, equipment, buildings, fixed assets. Depreciation. Most applications, depreciation is considered a non-cash expenditure. A non-cash expenditure. When did they buy the equipment? Day one, but they depreciated over a 5-year period. So year 2, 3, 4, and 5, those are non-cash expenditures. They're expense, but you dished out the cash when you first bought the equipment if you're the company. Snyder Corp, the manufacturer in Houghton. There is an exception we'll see on the 29th of this month when we get into the tax forms. Generally speaking, depreciation is a non-cash expenditure. We get to add it back into the cash flow. There is an exception we'll cover later, a couple weeks from now. What is amortization? Amortization is like depreciation, but it's for an intangible asset. What do you mean? Well, amortization is like it's an intangible asset such as goodwill, franchise fee, patent, logo. Those are assets, but they're not, that they're intangible. Non-cash expenditure though, like depreciation. Add it back in. Right below amortization, if you'll put another word, if you'll put plus depletion.
David, I'm so sorry. David, I'm so sorry to interrupt. I have to go and do a notary. I'll be right back.
No problem.
Keep going though.
Keep going. Keep going. Okay, no problem. Thank you. Thank you, Olivia. Okay, underneath amortization and the word depletion, DEPLETION. Now, what is depletion expense? Well, it's like depreciation, but it is for a natural resource: timber, oil, natural gas, coal, timber, oil, natural gas, coal. Okay. Now you can see, instead of EBITDA, I would put EBITDA, I'd put another D, and up above even another D. Okay. So but that depletion, you don't always see it. You don't always see amortization. You may not even see depreciation, although that's the most common of the three. Those are all non-cash expenditures, although depreciation does have an exception we'll cover later in the 29th of this month. EBITDA inflow or DA, either way, minus the debt service gives us the margin. EBITDA inflow divided by the outflow debt service, P&I, principal interest, gives us the DCR. Josh, does your bank call it a DCR or DSCR?
Debt service.
And that's the same. It's the same debt service coverage ratio, or debt service, or I even see the DC debt coverage or debt coverage ratio. It's the same thing. How did you get the 2.4? 1.2 million divided by 500,000 gives you the 2.4. Don't take the 1.2 million divided by the 700. I've done it before many times. Unfortunately, that's an error. How do we interpret 2.4 times? For every $2.40 of inflow, there's a dollar outflow. For every $2.40 of inflow, there's a dollar outflow. It's always a dollar outflow. Was that good or bad? Look at the very bottom right of this page. Minimum standard nationwide is a 1.20. Josh, do you know at your bank, what's your minimum DCR for this one, for the commercial? Go ahead.
It is 1.1.
Wow, a little lower, a little lower. Let me ask you this: Do you
Ideally 1.2, but you know, I've seen it at 1.1.
Yep. Oh yeah, I've seen it too. Let me ask you: Does your bank bank the farmers at all?
Yes.
Oh, that a lot of farm deals, you've got to go down to 1.1. Why? Well, because the farmer, he or she shoves a lot of their personal through their books, a lot of their personal living, and it lowers the cash flow. And if you stay at a 1.2, you won't be banking the farmers. Would you agree with me, Josh?
Yeah, and I don't deal with the farmers much. That's more like Wisconsin. We acquired a large
there.
A large ag bank.
Yes. Good. Good. Okay, that's the formula. Let's turn forward to page 15. We're going to stop right there. Let's take our first 5-minute break of the afternoon. We come on back. We'll do the calculation as a class for the EBITDA for Snyder Corporation. Excellent. Thank you. Talk to you in 5 minutes. Thank you. Appreciate it. Welcome back, everyone. We'll continue forward. Olivia, are you back with us? Are you back with us? Josh, are you back with us?
Yeah, I'm back.
Good, excellent. Hopefully Olivia comes back soon. I know she had to do the notary, get tied up but let's go ahead and proceed forward. Here we go. What I'd like you to do is go to page number 8 and calculate the EBITDA and for 19, 20, 21. So we're going to calculate this together as a class, but if you'll work on 19, 20, and 21, and I'll give you a hint, Josh, there is no amortization. It's just depreciation. So you'll start with earnings at the very bottom, the net income, net loss, add back the interest expense, taxes, depreciation only. There is no amortization. There is no depletion as well. If you go ahead and take just a moment, 19, 20, and 21, please. Pardon me. So if you go back to page number 8 and grab those numbers from the income statements, respectfully. Cash inflow, EBITDA. Pardon me.
I'm so sorry about that, gentlemen.
no
I am
problem.
back.
No problem. No problem, Olivia. That's actually good timing because we've been on break. No problem. Olivia, if you will go back to page number 18, or pardon me, page number 8, and calculate, use the income statements, calculate the EBITDA for 19, 20, 21 here on page number 15. So you'll start with the net income, add back the interest, taxes, depreciation. There is no amortization. There is no depletion on Snyder Corp. And if you'll plug in your results on 19, 20, 21 on this page, but you'll go back to page number 8 to grab those numbers from the respective income statements. Remember, there's no M, no A, there's no A, and there's no D. The second D is depletion, DEPLETION, which is like depreciation, Olivia, but it's for like a natural resource, timber, oil, natural gas, coal, something of that nature.
Okay.
You bet.
And would you use, so then that's usually mostly used in like trucking companies, correct?
Yes.
For that depletion?
Well,
Okay.
no, depletion would be a company that has natural resources, a mining operation or a tree, something, a logging company or something. Forestry. Excellent. Yes. Okay. So go back to page number 8 and we're going to do this. Plug those in. Go back to page 8, grab the numbers, calculate those, add, and then plug them in 19, 20, 21.
Sounds like a plan.
You bet. Take just a moment more and we'll summarize these numbers, the inflow to the EBITDA for Snyder Corporation. Pardon me. Okay, Olivia, what did you get for the first year for 19 for EBITDA?
Oh, I think I am so close. 87 divided by. All right. So I got, that looks very wrong. It's saying that I got 21%, which I know that's obviously wrong. I think I did my math wrong.
Well, not percentage. We're looking at raw number. If you turn back to page 8, you can see we
Okay.
would take the net income, 87,960, add back earnings before interest, taxes, depreciation. There's no amortization, no depletion.
Okay. I was pulling my depreciation from the other side, which is where I went wrong.
Okay, so we just take 87,960, add back interest 62,500, taxes at 58,640, depreciation 18,900.
I'm still getting a percentage.
Yeah, somehow your
Okay.
calculator's set on percentage or something. Just
No,
take,
because EBITDA is income divided by loss, interest, expenses, tax, depreciation, and amortization.
no. Please look on your screen, page number 8. Just start at the bottom, 87,960, and just add those steps if you would, please.
I think she's getting mixed up. The Olivia, the net income, it's net income / loss, not divided by loss.
Yeah.
Okay, because that's where it was killing me. That's why. That
So
is
net,
slash
so
losses.
for that first year, net income, net loss, 87,960. Add back the interest, add back the taxes before interest, taxes, depreciation. There is no amortization, no depletion for this case study.
Okay. It was that slash. I kept thinking that was dividing because it's been dividing all.
Oh, no. That's just one to the other. That's just one to the other. You bet.
Okay. That's kind of where it was screwing me up. Thank you, Josh.
You bet. Thank you. Thanks, Josh.
Yep.
All right. So I'm sitting at around 228,000.
Even exact. Correct.
Okay.
Correct.
Yep.
$228,000 even. Okay. Take a moment, do 2020 and do 2021. Got to make sure we've got this. This is huge. Remember, the fifth and final of the Laylock model is the big C, cash flow. It is the number one, whether we're talking short-term or long-term. Short-term or long-term, as we covered way earlier. Go ahead, take just a moment if you would, please. And we want to plug those numbers in to page number 15 at the inflow of the cash flow, inflow. So it's profit or loss, and then add back. You bet.
Okay. Now we're on the right track.
Good. I know it's tough because you had to leave, and your whole mentality, his whole thought is like, oh, now I'm dealing with the client and signing the notary and so forth. You bet. And then shift back into the class. So we did go on break, that worked out well.
Awesome.
Okay. 2020. Josh, do you have 2020 for us?
134.4.
134.4 is correct. 134.4 is correct. Okay. 2021. Olivia, do you have that one yet?
I got 622,640.
622,640 exact. 622,640. Now we know that middle year was a tough year. You can see it right here. Okay, now that's the inflow to the EBITDA cash flow. What is the outflow? The debt service, P&I, principal and interest. Now, hold your eyes, don't look at your screen, but in your hard copy, turn back to page number 7. Turn back to page number 7, the balance sheets. Of course, the balance sheets, we're going to find the liabilities of the debts. Now, if you look on page number 7, let's start with the bottom to the top. Do you see long-term debt? It was $1 million, now it's down to 500,000 on the bottom right-hand side of the page, page 7. Let's say that this is an equipment loan Snyder Corporation has, and let's say it's amortized over a 5-year period. And just to keep the numbers simple, if you would put 100,000 off to the right of 500,000, that's the principal. Remember, the debt service is P&I, principal and interest. Okay. Now, what about the interest? Let's say that it's prime plus 1. Now, prime is currently 4.75. It jumped. It's anticipated to jump again. But prime is currently variable rate 4.75. So you would take the 4.75 times the 500,000, gives you 23,750. Pardon me. Let me do that. Oh, pardon me. We're not going to do it prime. We're going to do prime plus 1. I apologize. Our pricing is usually prime plus 1. So prime is 4.75 plus 1 is 5.75 current interest rate. So we take 5.75 times the 500,000 gives you 28,750. 28,750 for the I. The principal is 100,000. The I or interest, 28,750. Any questions on that? Josh, question on that one?
Nope.
Got it. Now, go up above. You can see there's accrual. Accruals will be paid out in theory or cleared out by the receipt of the receivables. What about accounts payable? The same way. So the only other debt service we have are the notes payable, which is 300,000 in this case. You'll notice the previous year it was 720, but it dropped down. Why? Remember, Sawtooth sold off 49% of his business, took the 1.2 million, and at least part of what he did with it paid down the debt, which was actually negative. He blew the loan covenant that says you can't sell off part of your business without our bank's approval. Without the bank's approval, he did it anyway, but at least he was conservative in what he did with the dollars. So the only other debt service is the second is the 300,000. Let's say it's a line of credit that's maxed out. Most commercial underwriters, to do the calculation of the debt service for the line of credit, they'll simply use the maxed out line of credit and go interest only. So it's really not P&I, it's just interest only. So we'll take the 300,000 and let's say this is priced at prime plus 1 or 5.75. We do the math. If you'll do the math with me, 17,250. Do we agree, Olivia? Olivia, do you see that? Do you agree with that? So 5.75% interest times 300,000, you should arrive at 17,250.
Which I did, which makes sense because I've been doing lately just a lot of, I've had a lot of lines of credit maturing. So I've been learning as I go with line of credit.
Yes. Well, in lines of credit, the most common nationwide in our industry is let's say the line of credit was a $300,000 line, but let's say it was only 200,000 outstanding. Well, most underwriters will make believe that the line is maxed out at 300 and go interest only. The most common,
and that's what we've been doing,
which is the most common approach nationwide, including your bank, Olivia. So that is 17,250. Prime plus 1 or 4.75 plus 1%, 5.75 times 300,000, 17,250. Josh, you agree with me? Do you agree with that?
That's in 2021.
That's in 21. We use the most recent debt service.
Okay.
We use traditionally, and we're going to see this. Most commercial lenders will use the most recent debt service and then overlay it backwards on the previous years. Now, I've had CPAs ask me, well, when I train them on this, well, why don't we do year by year, the actual? I said, well, typically we would use the most recent and overlay it backwards to see, could the business have serviced it during the previous years? Okay. So now we have principal of 100,000 in your notes off to the right, plus interest on the equipment loan of 28,750, plus interest on the line of credit maxed out at 300,000, 17,250, because we did prime plus 1, 4.75 prime plus 1% or 5.75 on both of these credit facilities. That's a combination. The interest, 46,000. Olivia, we see that, right? You got that?
Yep, I got 146,000. The interest is 46,000, and then you
46,
add the.
and the 100,000 principal. Good. Okay, now let's move forward to our chart. On the second category down, debt service, I put 100,000 for each year. Remember, we take the most recent year and overlay it backwards. Most recent year, overlay it backwards. Okay, now the interest is 46, but let's do this. We know interest rates are going to rise, okay, statistically. Let's just round it up to 50,000 on the interest. So for each of the years, put 50, 50, 50, because we know they're going to rise. Would you agree, Josh, that interest rates are going to rise in the short term from right now, from today forward?
Yes.
Okay, thank you. Olivia, are you talking about it in your bank, Olivia, in Escanaba?
Oh, yes.
Good. All right. How far is your bank located from Ludington Street?
Like a block away from
Okay.
Ludington Street.
Okay, great. Thank you. In Escanaba, right?
Yep, that's our Escanaba branch, and then we have
Okay.
the main branch in Gladstone.
Oh, and okay, and wait. Are you at the main branch or the Escanaba branch?
So I'm in the Escanaba branch currently, but we do have a main branch in Gladstone and then Rapid.
And Rapid. Okay, good. Okay, now 150,000 debt service combined. Okay, now respectfully for each year, take the EBITDA inflow minus the debt service to get the raw number margin. Don't do the DCR yet. Just do the margin for the 3 years, please. So it's the respective inflow minus the 150 for each year. Want to make sure we're on target with the numbers. And this is huge. This is important. We get this one right, because this is the fifth and final of the 5 C's. And once again, cash flow is number 1, short-term or long-term, either way. Take just a moment more on the margin, please.
Can I just go back?
Yeah.
And say, so we came up with the debt service because we had the 300,000 in the notes payable and the 500,000
Yes.
in the
Yeah.
long-term
Yeah.
debt.
Yep. And just to keep the numbers simple, Josh, we just said 100,000 principal on the long-term debt plus the interest, and interest only maxed out line of credit. Does that make sense?
Yeah.
In
So-
real life, you would probably get with Beth and she would probably email you that's the Sawtooth, Snyder Corporation CFO. She would probably email you, even an Excel spreadsheet with all of the detail of the debt, and you can just use the actual number. We're just estimating, or not estimating, just kind of keeping it simple for today's model. But in real life, you would have it not necessarily on the balance sheet, and especially on a company prepared financial statement. Now, if you had a reviewed or audited statement, Josh, you would have notes to the financial that would probably break that out. You'd have all the little nitty gritty detail. Make sense?
Yep.
You bet. But for today, just to keep the math simple, just rounded numbers, 100,000 principal, 50,000 interest. It was 46, but we recognize, rates are moving up. Push it, just round it up to 50 a piece, 50 each year.
Now,
Okay.
David, we got this. Just another quick question on the principal and interest. Is this based off a year of payment? So they paid
Yes.
100,000 in the principal?
Yes, because Olivia, good question. Remember, it's annual inflow, annual inflow, annual inflow, annual outflow, annual outflow,
Okay.
annual outflow. Now, what if we had an interim statement for 6/30 of 22? We would have just 6 months of inflow, and we would, of course, essentially half the debt service. So we would take
Okay.
inflow half a year, 6 months, outflow half a year, 6 months. You bet.
Awesome.
And
Cool.
not to
Thank you.
confuse, you're welcome. Not to confuse anyone, but Olivia, you may even see you'd have the fourth column, the interim. Sometimes some lenders will even put a fifth column, which annualizes the 6-month statement, both income and
Okay.
outflow. You bet. Okay, let's start. Olivia, what'd you get for the margin for the first year?
78,000.
You are right on the money. Josh, how about the second year?
Negative 15.6.
You are right on. And lastly, the third year, 21. Olivia, what did you get?
472,640.
You are right on the money. Okay, now, obviously that middle year, like we've said several times, what shows up in basically most all of the LALOT model, that was a rough year, 2020. Now let's calculate the DCR, the debt coverage ratio or debt service coverage ratio, same thing. You would take the EBITDA inflow divided by the 150, respectfully for each year. Pardon me, EBITDA inflow divided by the outflow, and the outflow is the same for all 3 years, 150 total. And that will give you the debt coverage ratio. If you'll go ahead and calculate those three, please. Pardon me. If you'll go ahead and calculate those three. What is the DCR for each of the 3 periods? It's simply the EBITDA divided by the debt service. EBIT 150 for each year, it's 150. EBITDA divided by the debt service, EBITDA divided by the debt service. Respectfully. Pardon me. Okay, let's go ahead. Olivia, do you have the first DCR for the first year, please?
I got 1.25, well, 1.52.
Exactly, 1.52. Thank you. Josh, how about the second year?
0.89.
0.89. It's not a negative 0.89. It's 0.89. It's below 1 to 1, but it's not a negative. Thank you. Olivia, do you have the third year?
Yep, and I got 1.317.
Oop, that's not
So
quite. If you'll redo that one again, you'll take the 622,640 divided by the 150,000. You may have divided it by the 472,640. Take the 622,640 divided by the 150,000.
There we go. Yeah, you're right. I did. All right. So right now I got 4.15.
You are right on the money. And by the way, that error while you were doing the notary, Josh and I talked about that. That error is so common, and I've done it myself about 100,000 times in my career. You take the EBITDA inflow divided by the margin, which is not correct. You do the inflow divided by the outflow of the debt service, which in this case is 150,000. Okay, so
I actually did the same thing.
oh, it's common. No, I'm really serious. I haven't done it 100,000 times, but I've done it many times, and I'm going like, wait a minute, two of these look normal, the other one doesn't look normal, and then I redo it. Oh, and that's what I did. Okay, so we have the 1.52, the 0.89, the 4.15, and then to the right of DCR underneath IND industry, if you look back on page 8, it's 2.0, 2.0 industry debt coverage. We know that the generic minimum nationwide in our industry is 1.20. This industry, meaning the banking industry, just generic, all businesses, whatever. But we know this industry for Snyder Corporation, this particular type of manufacturer that's based up in Houghton, is a 1 point, we know that the industry, their industry is 2.0. Our generic nationwide in our industry, the banking industry, is 1.20. Overall, strong, moderate, or weak, comprehensive judgment call. We have the whole table completed. Bottom left-hand side of the page, if you would put strong, moderate, or weak, or a little hedge in between, How would you assess this? In fact, while you're thinking about this, look at that first year, 1.52. That means for every $1.52 of inflow, there's a dollar outflow. It's always a dollar outflow. The second year, for every 89 cents of inflow, there's a dollar outflow. Ooh, they're starting to bleed. What about the third year? Oh, they came roaring back. For every $4.15 of inflow, there's a dollar outflow. Wow. Wow. Okay. Wow. Strong, moderate, or weak? What would you say? Strong, moderate, or weak? Overall, what would you say? Strong, moderate, or weak? Josh, we'll start with you.
I'm gonna go moderate just because, it was down at 1.5. Then it was negative, then it went even worse, and then they, had somebody buy in, which is all fine and dandy, but they needed the help.
Yeah.
So
your
now they're at
comments are
4.15.
comprehensive. Good. So moderate. Oh, thank you. Olivia, what would you say? Overall, remember the overall model.
Yeah, at the overall model, I would definitely say weak to moderate because, like as Josh said, like it's a good year, but he had to buy out a decent amount of the company. And even then, before pandemic year, he was still only at a 1.5, where his industry still like a half a percentage point above.
You're right. You are right on the money. And I would agree with both of you. I'd say moderate. Now, what if we had a 6/30/22 interim statement, Josh, that showed a DCR of 4. Now what would you say?
Now we're
4.0.
trending to probably moderate to strong.
Right
Probably
on.
I would go strong.
Yeah, I would too. I would too. Okay, now, excellent, excellent analysis. Remember, it's one thing to calculate these numbers. It's a whole other level to interpret them correctly. Excellent. You're both doing excellent. Now,
Hey,
one
David,
last, go ahead, Josh.
Can I ask a question?
Yeah.
What's a good resource for these industry averages?
We'll come back to that. Remember I mentioned RMA and I said, woo, section number 5, we're almost there.
Okay,
We're gonna look at it. We're gonna talk about industry averages. Where can you get some solid industry averages? You bet.
gotcha. 10-4.
You bet. 10-4, you bet. Excellent. Okay. DCR all the way over to the right. Look at the loan covenant. Whoa. Now, what's a loan covenant? What does the word covenant mean? It's a solemn promise between two parties, the bank and the borrower, the bank and the borrower. Okay, now, the 3 most common key ratios that are used in bank loan covenant making, if you will. If you'll put this on the top right-hand side of your notes, right above loan covenant. And this is no particular order. Number 1, the current ratio. We talked about earlier as an indication of liquidity. Number 2, the debt to equity ratio, indication of leverage. And the 3rd most common is the EBITDA. Now, actually, EBITDA is the most common, but I'm just saying just 3, and they're just 3 of these. Actually, if you say, well, which is really the most common? It's the EBITDA coverage. Seriously, what we just covered. And then probably number 2 would be the current ratio, and then number 3, the debt to equity. So it'd be cash flow, the debt coverage, then it would be liquidity, current ratio, then it would be leverage, debt to equity ratio, in that order. I just gave you the 3 in the order that we've covered them. But number 1 is the EBITDA, debt coverage. This is actually in writing. This is found within what's called the business loan agreement within the loan docs. And when Sawtooth, when he signs it, whoa, he's signing his name saying, oh, I'm going to adhere to this. Meaning my company, we track it usually quarterly. What if they blow the covenant? Well, we note it in the file. We talk to the customer. What's the most extreme? We pull the line. We freeze the line or we pull it. Yank it. Close it. Whoa, that's real extreme. Okay, now I'm going to ask each of you, what loan covenant would you put on this customer for the EBITDA debt coverage? Based upon this chart, based upon the historical numbers, based upon their industry 2.0, and based upon our generic minimum for every business that we deal with in the bank, in the whole industry, the whole nation, we know is the minimum is 1.2. It's a measly 1.2. And sometimes, like Josh, you said, it's down to 1.1. What number would you use for the loan covenant? The EBITDA loan covenant. What would it be? Would it be the generic minimum 1.2? Would it be their industry of 2.0? Would it be a 1.5, roughly what their first year was? What would it be? What number? And remember, you put this covenant on this client. You want it to be meaningful, but at the same time, you don't want them to blow it right out of the chute, or blow it, 3 of the 4 quarters of the year that you're tracking this. That's going to be painful for you and them. You have to do a lot of extra work. You want it to be meaningful, but not, so there's a meaning in the number, but not so extreme that they just blow it, and it's like, whoa. Take just a moment more on this. Write it down. Underneath loan covenant on the right. What DCR would you use to track this company? And it's in writing. And they signed that business loan agreement. They acknowledge this. This isn't just you and Beth, the CFO. No, this is Sawtooth, Beth, and you, the loan officer. Olivia, what number would you use? Olivia, what number would you use, please?
Well, sorry, my mic was off. With it being such a good year in 2021, but yet again, it's hard to say because we don't have 2022 numbers yet, or not even like a half a year numbers to
Yep.
see where it's going. I would almost put it at industry average right now.
2.0. Okay, so you go with the industry 2.0. Josh, what would you go with? What number would you go with?
Me personally, just because of, you know, our bank's at 1-to-1. 2019, what you would call a normal year was at 1.5. Although below industry average, I think it's fair because not everywhere is equal in the United States. I think 1.5 is a fair.
1.5. 1.5. My personal opinion would be 1.4 to 1.5. Somewhere in that
Okay.
ballpark. 1.4, 1.5, no lower than 1.3 in my opinion. It's got to be somewhat above our generic minimum nationwide 1.2 standard. But Olivia, at least somewhat towards the direction of their industry. Would you agree? Their industry.
Mm-hmm.
Good. Excellent. By the way, can you change this? Meaning you put this in place for 1 year, you renew the line of credit and so forth. Could you change it? Yes, of course. Is it negotiable with Sawtooth, Beth, the CFO, and yourself? Oh, yeah. Because you're going to say, hey, we're going to put these 3 covenants: current ratio, indication of liquidity; debt to equity, indication of leverage; and the debt coverage, indication of debt coverage, debt service. Oh, yeah. It could be negotiable. It could, to a certain level, negotiable between the bank and the borrower. Excellent. Let's move forward. Model number 2. Now, we're not going to calculate these or the global. We'll do this. We'll actually look at this more in depth on the 29th, once again, of this month in the cash and the tax class. Why? Well, because if you look at the top left, what's the source of these numbers? Salary, business income, rental, K1 pass-through. It's from the tax returns, both personal for Sawtooth and business. In this make-believe example, 500,000 cash inflow. Remember, 1M is 1,000, 2M is 1,000,000 in Roman numeral system. We then subtract off federal and state tax, 150,000. Gives us 350,000 available for debt service, minus the debt service 200. This is his personal. This is not the business. Oh no, the business was on the EBITDA. This is the first on his home, the mortgage, the second, the HELOC or home equity line, the boat loan and RV loan and all that. Monthly payments, all combined times 12. Annual debt service. Why? Annual inflow from the tax return. There is no interim. Even if you wanted, there's no interim in this because the inflow is from an annual tax return. 350 minus 200 gives us 150 margin. 350 divided by 200,000 gives us debt coverage ratio of 1.75. Now that's the basic flow. Let's go back and dissect. You would have 3 years in reality. You're in 19, 20, 21. Tax return, inflow up above. What are we going to do on the 29th of July? Oh, in Marquette, physically and virtually both. We're going to dig through the personal tax returns, all the schedules, all the K1s. It's in depth just to get to that 500,000 correctly. Subtract off federal and state tax because you both live in Michigan. You have the dubious honor, you love that word, dubious honor of paying both federal and state. But what if you're based in Texas or Florida? There are 9 states that have no state income tax, including Texas, Florida, and so forth. Because you're in Michigan, you pay both federal and state is in the model. You're in Texas, and if Sawtooth was in Texas, Snyder Corp, only federal in this model, because the other doesn't exist. 350 minus the debt service. Right below debt service, you'd put living allowance. Starting about 4.5 years ago, federal bank examiners started saying, you know, we want a living allowance in this model, in this cash flow model. Here's a common way it's done. 15,000, or pardon me, now with inflation, let's go up to 20,000 per adult, 10,000 per child. Sawtooth and his spouse, 40,000, 2 kids. Let's say they have 2 kids, 10 and 10, 20, 40 plus 20, 60,000 total. With inflation, some banks are now, not 20, 25 per adult, 15,000 per child. I'm serious. Living allowance, it would reduce the margin, reduce the DCR. How do you interpret a 1.75? Just using these numbers. For every $1.75 of inflow, of course, inflow to the household, to the personal, there's $1 outflow. It's always $1 outflow. Look at the most common minimum, 1.20. Let's go to the third and final, cash flow. Global. Well, has nothing to do with international trade, international banking, nothing to do with any of that. This is simply, as you can see, the combination of both the business EBITDA cash flow we just did and the personal combined. Combined margin, raw number, combined DCR. In this example, 2.21. What is the minimum nationwide combined DCR for global cash flow? 1.20, no surprise, 1.20. By the way, used to be global cash flow was optional in our industry amongst commercial lenders. Today, global cash flow, which once again is just the combination, it's nothing to do with international trade or whatever. Today, starting 4.5, 5 years ago as well, the federal bank examiners start saying, we want a global cash flow. Why? Remember we talked about the alter ego theory earlier today? The business and the business owner are the mirror image of each other, and essentially they're combined. This is the combined. Josh, any questions on EBITDA business, personal cash flow, and or the combined global? Any questions on this?
Nope.
Good. Olivia, any questions?
Nope.
Good. Now on the 28th, 29th of this month, we will do more cash flow modeling, some similar, some the exact same, but when especially on the 29th in the tax class, whoa, it's a whole different level. Instead of extracting the information from a financial statement, whoa, tax returns, there's a lot more to it. The main tax return, the 1040 for the individual, the schedules, the K1s on the personal, and then on the business side as well. And then we'll combine the two together. Moving right along. Now, our fifth of our 6 areas. We'll go ahead and take this one, and then we'll take our last break of the session, just a few minutes. Industry comparisons, okay? In this section, industry comparisons and the spreadsheets. Well, industry comparison. Josh, you mentioned this. RMA, Risk Management Association. A lot of banks use it. Your bank can buy the book. It's about that thick, about 3-4 inches thick, and or the online service. Some banks will purchase both for their commercial lenders. What if you don't have RMA, or your bank is strapped on the budget from a budget standpoint? What do? You go to your main public library. You walk into the library, you go to what is called the reference section. Most likely you will find the RMA studies. It's once again, the hard copy book about that thick. It's got almost every industry or sub-industry in America you can imagine, including the key ratios we just covered in the lay lot model, that we've just completed the lay lot model. Now you cannot check it out, but you can look at it, use the numbers. Standard & Poor's is another one, S&P. Standard & Poor's. D&B stands for Dun and Bradstreet. There are numerous. Ask your client. If it's ABC LLC in Gladstone, ask your client, hey, ask them, well, Bob and Sue, Jane, where do you have some numbers? Oh yeah, we track our own industry relative to us, our company relative to the industry. Or Sawtooth and Beth up in Houghton. Yeah. Spreading the numbers. You both spread the numbers and or have the numbers spread for you. We established that earlier. Here are some common software programs: Moody's, SageWorks. Now, Olivia, I believe you said you use SageWorks, right?
Yes.
What software do you use, Josh, or in your bank? Do you recall? What's the name?
It's Baker Hill.
There's Baker Hill right there. SageWorks, Baker Hill, Moody's, Buchers is another one. Excel. The only thing I say about Excel is, wow, make sure the numbers, the key ratios, the formulas are correct. By the way, for whatever it's worth, Olivia, you see SageWorks. This is my observation over the last 5 years in our industry. It used to be Moody's was the dominant. SageWorks is catching up quick. That's expanding amongst the banks for whatever it's worth. And also, SageWorks oftentimes will have an industry comparison built into the software, which means when you submit into SageWorks, whatever the nature of the business or the type of business, it will log it as part of the industry comparison. Do you know, Olivia, when you look at SageWorks, do you have?
I have.
Do you have the industry?
Used that when you add in your NAISC code.
Yes. Yep.
When you print off your full credit analysis, it'll
Yes.
actually have industry totals and compare it with the industry.
It is slick.
It's awesome.
It is slick. It is already included. So when you're inputting, and let's say you're dealing with the contractor, okay, a general contractor or whatever. Well, the general contractor, you're going like, well, wait a minute. All of a sudden it pops up, similar size company, general contractor or retailer, wholesaler or manufacturer, whoever. Absolutely. Now we're going to look at the spreadsheet. We're going to do a quick activity, do our last stretch break. And then we will come back and do, after the break, our 2 advanced models and conclude the class. The Altman Z-score, bankruptcy predictor, and sustainable growth that the software generates. These are the advanced key ratio models. Now, if you'll turn with me, this is a Moody's spreadsheet. This is sample contractor. This general contractor is based in Escanaba. 08, 09, 10. Ooh, what happened during these years? The Great Recession. Whoa, these were tough years. Now, Olivia, you do this. Josh, you have people that do this for you. They spread the numbers. They load the balance sheets in thousands. And the next page, they load the income statements in thousands. Look at the loss in 08. Look at 09. Company almost went under. Once again, unlike the case studies in my textbooks, in the college arena, oh no, loss? Oh no, they're always profitable. They're always strong. Not in real life. Would you agree with me, Josh? In real life, that's not always the case.
100%.
Oh, yes. Okay, now, from here on out, the software does the analysis. This next page, page number 3 of the spreadsheet, this is common sizing of the income statement. I didn't do all this analysis. No, I loaded the balance sheets, income statements. The rest is history. By the way, this is a real CFO client of mine, of course, not based in Escanaba. That's just to illustrate, based in Vegas.
Mm-hmm.
But if you'll put in your notes, model number 4, this is model number 4, operating performance of our 5-step lay lot model. Turn forward. This is a UCA cash flow, Uniform Credit Analysis cash flow on the top left-hand side. This is sources and uses of cash flow. We'll save this for another class, the in-depth discussion on this one. Uniform Credit Analysis cash flow, true cash flow, sources and uses of cash. Kind of like we mentioned earlier with Walmart, operating, investing, and financing, the three big areas. Now the key ratio page that once again, the software just spits out. Now this is the last page of the Moody spreadsheet. Right at the top left-hand side, do you see the word liquidity? If you'd put a number 1, please. Pardon me, about 3/4 of the way down, do you see the word activity? If you'd put a number 2, this is the layout model. Go towards the top left-hand side again. Do you see the word leverage? If you'd put a number 3. So liquidity, activity, leverage. What about the O? That's operating performance or profitability in the middle of the page. I put a number 4. Profitability, operating performance, same thing. And then just above that, a hair, do you see where it says cash flow coverage? I put a number 5, a number 5. Okay, a number 5. Now, to simplify this, because there's a lot of information. Pardon me, if you'd be so kind as to turn forward to page 24. Pardon me, this is a spreadsheet that I create. I've labeled and separated the layout model, including put the definitions there. Now you say, well, where'd you get all these numbers from? Well, I got them from the previous page, the Moody spreadsheet, or the SageWorks spreadsheet, or the Baker Hill. It's the same idea. I've also added the RMA, or Risk Management Association industry studies, to the right. Okay. Now, Olivia, in your software, oh, you don't have to add it manually. It's already done in SageWorks, right? It's already, you said it, it prints out on the side.
Yeah.
So you can do automatically in Olivia's world, in your world, self to industry. I had to manually add this. Okay, now let's do the first one of the 5 steps. I'm going to have you do 2, 3, and 4 on your, or pardon me, 2, 3, 4, and 5 on your own. Then we'll come back together, but let's do the first one, liquidity. Look at the numbers. These came from Moody's spreadsheet. The first working capital raw number. Look at current ratio. That 4.91, that's odd. I'd slash through that. And that happens. In fact, look at activity under AP. Do you see 3 days the first year? I'd slash through that, odd. Let's go back up to the current ratio. You see the 0.80, 0.78, 0.91. And you notice with RMA, many of these have a range of numbers. 2.5 on the high, 1.2 in the middle, 0.7 on the low. Well, I'll just say it straight out. I mean, it's obvious all 3 of these periods are on the low, but they're not below a 0.7, thankfully. My personal judgment overall, remember we do the comprehensive. To the right of this first model, liquidity, I put the word weak. My personal opinion, self to industry, macro or large assessment, combo assessment, weak. Josh, would you agree with me?
Yep.
Olivia, would you agree with me?
Yep.
Okay, now on your own, look at activity. We slash through the 3 days, look at leverage, look at operating performance, look at cash flow, lifeblood, self to industry, and over to the right, if you will put one comprehensive word or phrase, strong, moderate, or weak, or a little hedge in between. You can have a little hedge in between. Take just a moment or so. Look at the numbers, interpret the numbers, strong, moderate, or weak, or a little hedge. So you'll have one phrase off to the side of activity, of course, leverage, operating performance, and cash flow. Number 2, 3, 4, and 5 steps. Pardon me. Take just a moment on this, if you would please. Take just a moment. Look at the numbers. You're simply interpreting. We've moved on from the calculating. The spreadsheet did it for us. Here are the results. And I've added, of course, the industry comparison. Strong, moderate, or weak, or a little hedge in between. Pardon me. Simply interpret the numbers, not calculate, just simply look at each one of the steps and make an interpretation, your judgment call. Take just another moment or so, please. Okay, Olivia, what did you put for activity? Strong, moderate, or weak, little hedge action, little hedge in between.
I just based on the industry and based on industry to self to self. I'm putting it as like a weak moderate.
Weak, moderate. Thank you. Josh, how would you interpret activity?
I did the
Strong,
same.
moderate,
I
weak,
did the
moderate.
same, moderate, weak.
Moderate, weak. My personal opinion, I would say moderate. That's my opinion. The previous years were weak, but boy, 2010 and the interim, I know it's only 1 month, but look at that on the AR. Ooh, that's not bad. That's in the midpoint, roughly. And the AP, ooh, even though it's on the out, it's kind of getting towards that 35 days. But remember, back on cash conversion cycle, whoa, if the AP stretches out, it actually helps the company. Cash conversion cycle. My personal opinion, moderate. You both said moderate to weak. Okay, what about leverage, model 3? They're all negative. Of course, the net worth is a negative. That's why they're negative. We'll start with Josh. What's your judgment call on leverage?
I put weak.
Weak. Olivia, what's your judgment call on leverage?
I'm going with I'm actually gonna go with moderate.
Thank you. My personal judgment call on leverage, model 3, moderate. Negative net worth, which is why they're negative. But look at the comparison to the industry. My personal judgment call would be moderate. Now, could you argue weak? Oh, absolutely. Well, they're all negative. And because it's got a negative net worth. But relative to the industry, not bad. I'd still call it moderate. Okay, what about operating performance? The profitability, gross profit margin. Remember, not the raw number, the percentage like we did. Self to self, self to industry, net profit margin like we did, and then just the net profit. That's just the raw number. Overall, Olivia, what would you say on operating performance? Strong, moderate, or weak, a little hedge in between?
The way that it's going, I'm going to say moderate to strong.
Moderate to strong. Josh, what would you say on operating performance?
I just put moderate.
Moderate. My personal opinion, moderate to strong. The reason why, look at the trend in 10 into 11. Now, 11 is just 1 month. Boy, if that was a 6-month statement with that improvement in the profit margins, whoa, I'd be tempted to say strong. But because it's only a 1 month, my opinion, like Olivia, moderate to strong. Fifth and final, cash flow lifeblood. strong, moderate, or weak, or a little hedge in between? Josh, we'll start with you. What would you say?
I would say moderate to strong.
Moderate to strong. Olivia, what would you say?
Well, I went weak to moderate.
Weak to moderate. And my personal opinion, moderate to weak. Went moderate to weak. Okay. Now you can see we all have different opinions. Sometimes we all three synced up. Sometimes two of us synced up. Sometimes none of us synced up. When we come back from our break, we're going to talk the 2 advanced key ratios. Before we do so, if you'll turn back one page, I just want to show you where I got the numbers from. Under this is, I turned back to page 23, the last page of the Moody spreadsheet, the ratio page. Look under activity at the bottom left, towards the bottom left. Do you see the Z-score? I'd highlight Z-score and the numbers to the right. And then at the very bottom below growth, do you see sustainable growth and the numbers to the right? I just want to show you, well, where did they come from? I didn't calculate it. Oh, no. I mean, you could manually calculate. It'll be there for hours. No, the software does it for you. The Moody's, the SageWorks, the Baker Hill. Let's move forward and we'll stop on page 25. For the sake of time, let's take just a 3-minute stretch break, if that's okay. Let's take a 3-minute stretch break and we'll come on back, do these 2 advanced key ratios and wrap it up. Thank you. Talk to you in 3 minutes. Thank you, everyone. Welcome back for our last little snippet or section. Olivia, are you back with us? Can you do our sound check, please?
Yep, I'm here.
Excellent. Josh, are you back with us?
Yes, sir.
Excellent. Okay, now the Altman Z-score. If you look at the second paragraph down from on the top there, this is technical. A lot of people call it the Z-score, but you may have had a statistics class back in college or wherever, or stats class for short. You may remember the Z-score. That's a different Z-score than this. This is the Altman, A-L-T-M-A-N, named after Professor Altman. Well, it's a comprehensive key ratio, advanced. Remember back of the Laylock model, that last activity, one of the items was weak, one was moderate, one was strong. Well, wouldn't it be great to have one key ratio that tells us generally the direction of the business? This is it. It's called the Altman Z-score. It's a bankruptcy predictor. What is the worst thing that could happen to your borrower financially? Most people would agree. Look at the sign there. United States Bankruptcy Court. Now, is it perfect? No. In fact, I was in a session just a few months ago, and one of our participants said, well, I researched this is about 72% accurate. Well, I take 72% for at least an indication of direction. Look at the formula down below, an example of an Altman Z-score. Look at the variable 3.3C is the heaviest weight. And if you look down below, not surprising, it ties into the EBITDA cash flow divided by total assets. Now, because you both work with primarily small to medium-sized privately held businesses, under Part D, I'd slash through the word market and put book value. Okay. Now, if you turn forward, page number 26, these numbers came from the Moody's spreadsheet that I had you highlight right before our quick break. For Sample Contractor, this small little general contracting company. Well, look at the numbers. Look at 08. This is the Great Recession. Look at the scale down below. If you have an Altman Z-score over 3, in theory, you're far from bankruptcy. If you have a 1.8, 1 to 3, kind of in the middle. If you have 0 to 1.8, my slang terminology, you're in the death zone. Because my CFO clients over the years, if they're in that 0 to 1.8 and they don't make drastic changes, they die. They're in bankruptcy court in real life, not just theoretical. Now, once again, look up above. These are the numbers I had you highlight, once again from Moody's, from the last page of the spreadsheet. SageWorks does this, Baker Hill does this. Now, I've had some people say, like on Moody's, well, you have to pay for extra for that option and so forth, whatever. Now look at Sample Contractor, this small general contractor in Escanaba. The first year, they're almost out of the gray zone. But what happened in 09? 09 was the peak of the Great Recession. They almost died. I went to the client, this CFO client. I wasn't his banker, I was CFO. I had showed him these numbers. He laughed at me. Oh, that doesn't mean anything. I said, no, you will go BK if you don't take some drastic action. He looked at me, then he got real serious. What I didn't tell him, I couldn't tell him, is that I was working with several other small contractors in the market at the same time who buried their heads in the sand when I showed him this analysis, and they end up 3-4 months later at the most filing bankruptcy. So he took it to heart, laid off some non-productive employees. That was a little bit benefit, mainly bidding the jobs better and delivering in the field better than before. Look at these numbers in 10, 11. These are real numbers, real company. Did he turn the corner? Yes, the company. Did they avoid bankruptcy? Yes. Did they survive the Great Recession? Yes. Questions on this? Olivia, questions on the Altman Z-score? Any questions?
Nope.
Got it. Now turn back to page 25. At the bottom of this page, what if your bank does not have Moody's, SageWorks, Baker Hill, and you do, you both do, which is great. You can calculate your own Altman Z-score. If you'll put this at the very bottom of page 25, what you would do is you would Google Altman Z-score, not Z-score, Altman, ALTMAN. You'll find at least 3 or 4 Excel-based templates already prepared, free of charge. Now, look at the variables. You can see in the middle of this page, you would have to put the variables at the working capital, which you can do. We've done the analysis, the total assets and so forth. So in these Excel-based templates that are free of charge, you plug in the variables, you can create and run your own Z-score. But because you both have software that it's included, generally it's included in the key ratio page in your spreadsheet, just like we saw in this example. Josh, any questions on this? Any questions on this?
Nope.
Got it. Now let's move forward. Our second and final of the advanced key ratios. Sustainable growth. Just move forward to page 27. Sustainable growth model. Now, what is this? Well, if you'll circle or highlight the middle paragraph where it says in order to grow faster. And what is this? This is kind of a status quo relative to sales, internal sales in the company. How much can they grow internally without any outside support? Well, what you can see, no additional equity. That would be like Sawtooth putting the money into the business. Or if it's a Walmart, issuing an additional $100 million in new common stock, equity into the business. How about increase in financial leverage? Sawtooth, Snyder Corporation, and Houghton obtaining a new equipment loan from your bank. Or a big publicly traded company like Walmart issuing $100 million in new bond offering. Financial leverage is debt. Whether it's a bank loan, bond, doesn't matter. Or this model, quote unquote, assumes no increase in the profit margin. Now, obviously, Snyder Corporation, Sawtooth Company, boy, they want to grow this. They want to grow it. Yes, but most all businesses, even Snyder Corp and even a Walmart, they need outside support to continue to grow, to further capitalize the business. Equity, debt, or financial leverage, and improvement in the profit margins. Look at this next page, please. These are the numbers from Sample Contractor. I had you highlight about 4 pages back, last page of the Moody's spreadsheet for Sample Contractor in Escanaba. Well, what does this tell us? In theory, internal sales can grow from 08 to 09 to over 107%. 09 to 10, about 63%. But then you notice it slows down. It goes into the negative growth. Because, and this is Sample Contractor, but these same trends would be with Walmart, because the model, quote unquote, assumes no additional equity, no additional debt, financial leverage, no additional improvement to the profit margins. Kind of interesting. How much can they grow sales-wise internally without any outside support? I think this is kind of an interesting model to look at. But my personal opinion from a commercial lending perspective, the Altman Z-score, well, because the big picture, your small to medium-sized borrower, what's the worst thing that can happen to them financially? BK, bankruptcy, BK all the way. My personal opinion, in your loan write-up, at the end of the 5-step laylout model of the key ratios, including that last of the C of cash flow, I would then put like a little chart, an Altman Z-score summary, year-end 19, 20, 21, interim period of 22, 6/30 of 22. You could even show quarter to quarter, second quarter, the first 6 months of 20, 21, 22 even. Moving right along. In conclusion, look at the final thoughts under BC, B1C. You see B1A, cash is king. That's an old saying from way back. Credit is king. Well, if anything, we learned back in 08, 09, the Great Recession. Oh, those aren't really what you think they are. They may not materialize. My personal opinion, and I'd highlight or circle of the 5-step laylock model, cash flow is king. Number one, short-term or long-term. Look at number 2 down below. Figures lie, liars figure. My old boss used to say that. She used to say that to me when I was on your side of the table. David, if the numbers are too good to be true, they probably are. Figures lie and liars figure. Negotiating with other people. Number 3, internal, external. I put under number 3, internal in the bank, external. Lastly, you use the laylock model. You please be a decision maker with the numbers and especially the interpretation. With that, we're going to do a quick activity and get you on your way for the day. Josh and Olivia, pardon me, would you go back in the material and come up with 1 or 2 major takeaways? 2, let's do 2. 2 major takeaways from today's session. If you'll write them at the bottom of the page, and then I'll ask you in a moment. There's not a right or wrong. I'm not looking for a magic answer. But what are 2 takeaways that will benefit you personally from today's session? There's not a magic answer. It's personal. Go back. I go all the way back to the intro, the introduction to the laylock model, the accounting section, the laylock model expanded, the industry comparison spreads, and then the 2 advanced key ratios. 6 areas. But it could be a major, like it could be the laylock model, or it could be even just one little concept in one of the multiple models we've covered today. Doesn't have to be one of the major areas of the 6 areas. It could be, but it could be just one little facet as well. Come up with 2 and then put them on the bottom of this page, and then we'll summarize using those models or those 2 takeaways. Okay, so take just a moment more on this. It's not a right or a wrong to this. 2 takeaways, if you would, please. 2 takeaways. It's not a right or a wrong to this. 2 takeaways that will benefit, things that will benefit you. Take just another moment on this, if you would, please. Okay, Josh, we'll start with you. What are your 2 takeaways, please?
Just the cash flow calculations, the EBITDA, that was one of the big things that I was looking forward to. And then just the interpretation of all the numbers.
Good. So the EBITDA cash flow and the general interpretation of all the numbers. Good. Olivia, what are your 2 items, your 2 takeaways, please?
Well, I'm only 6 months into this new position, so
Yes.
being young, I'm still trying to get a concept of how these ratios work together. Why do we analyze them? This was a huge step in
Good.
understanding those ratios, but
Good.
also being able to take time and to be able to analyze. Granted, I'm not going to be right all the time on my analyzing, but being able to understand what is the type of process would look like.
Good. Excellent. Excellent. Both of you. Excellent. Well, with that, I want to thank you too for excellent and excellent participation, both in calculating the numbers and even the interpreting. When we did that comprehensive case study using the ratio page for sample contractor, your interpretation of the 5 steps, the 2, 3, 4, 5 of the 5 steps, that was excellent. Very good summary of today's entire presentation and session. With that, I look forward to working with you in upcoming classes. In the meantime, if there is anything I can do to assist you, as I mentioned earlier, please send me an email. With that, thank you, everyone. Have a good rest of your day and a great rest of the week. Thank you. And a great weekend coming up as well. Excellent. Thank you,
You as
everyone.
well.
Thank you, David.
Great
Thanks,
job.
everyone.
Thank you.
Take
Thank
care.
you.
Thank you.
Thank you, Josh. Thank you, Olivia. Thank you,
Bye-bye.
Stephanie.
Thank you.
Thank you.
David, so no, Jacob didn't come?
Jacob did not come.
Okay,
So, okay. Oh, but we're by ourselves, correct?
yes.
Okay.
Uh-huh.
And you stopped the recording or whatever. Jacob did not show in any way, shape, or